Good evening, everyone. So we are going to start with the next chapter that we are left with GST, that is refunds under GST. Refunds under GST usually, like 2 attempts once they will be asking a question for 5 marks, and even in MCQ also they will be able to ask these questions. But of late it's not becoming that much important. In old, that is before 2018, they used to ask a lot of questions, but now they have reduced it. I mean, before 2024 they used to ask a lot of questions. After 2018, so look into this refund under GST. This is the illustrative list, page number 172. There are many cases where the refund is possible, and the first one is refund of IGST paid on import. So whenever we are making export, we have option 1, pay IGST and get refund of that IGST. This is option 1. Or option 2, refund of unutilized ITC. That is again in case of zero rated supplies. In case of zero rated supplies, we have 2 options, pay IGST and get refund of IGST. Option 2, don't pay any IGST and export it under bond or LUT and get refund of ITC. And refund on account of unutilized ITC is also due to inverted tax structure. That is, a tax rate on output is less than the tax rate on input. Refund on account of deemed export. So sale to advance authorization, sale to EPCG holders and sale to EOU is treated as deemed exports. In that case, there is a refund. Refund of balance in the cash ledger. So whenever there is some excess balance in the cash ledger, maybe CTP and RTP who deposited some balance in the cash ledger because they need to pay advance tax, that advance tax will be adjusted towards the liability, and the remaining balance in the cash ledger we will be able to get it as a refund. Or normally also a normal taxpayer will deposit some excess amount in the cash ledger, and that also they can claim as refund. Refund on account of issuance of refund vouchers. On the basis of advance, we will be giving receipt voucher and the advance will be cancelled. A refund voucher will be issued. And refund on account of wrong classification, treating intrastate supply as interstate supply and vice versa. So when we treated intrastate supply, we would have paid CGST, SGST, but actually it is interstate supply. So we'll pay IGST and we'll get the refund of CGST, SGST. Refund on account of provisional assessment. So first we will pay the provisional tax. Upon finalization, if the final assessment tax is less than the provisional assessment tax, the extra what we have paid, we will get it as a refund, that is this. Refund on account of any judgment, decree or order. So first we will pay demand order some amount, and thereafter we will go for appeal against the demand order, wherein government, the appellate authority, either Commissioner Appeals or GST-80 or High Court or Supreme Court held that this order is not valid. So in that case, whatever tax that has been paid, we will get it as a refund. That is refund on account of judgment, decree or order. Refund to UIN holder, and UIN holder is a person, that is embassies or consulate or UN agencies. Their outward supplies will be exempted. On their inward supply GST paid, they can get it as a refund, that is refund to UN holder. Refund of excess payment of tax, by mistake any tax is paid in excess, so that they can claim as refund. And refund to unregistered recipient. So if the supplier has not issued the credit note, so in that case the burden of tax is on the recipient, and the recipient can claim the refund even though he is unregistered. These are the various situations where a person will be able to get the refund, and refund is always subject to unjust enrichment. However, there are few cases where unjust enrichment is not applicable. Unjust enrichment means the person who is claiming refund should prove that the burden is not transferred to the next person. How to prove that the burden is not transferred to the next person? For which they need to either give a declaration or give a CA or CMA certificate. If the claim of refund does not exceed 2 lakh rupees, then it will be self-declaration. If the claim of refund exceeds 2 lakhs, then they need to get a CA or CMA certificate. That is this. To establish that there is no unjust enrichment, a declaration by registered person is required. If the amount of refund does not exceed 2 lakhs, and if the amount of refund exceeds 2 lakhs, a certificate from CA CMA is required to be filed. Refund is subject to the condition that there is no unjust enrichment, which means that refund shall not be granted if registered person failed to prove that burden is not transferred to the recipient. And if declaration or certificate is not submitted, the money will go to consumer welfare fund. And these are the cases where neither declaration nor certificate is required. So one is refund of unutilized ITC, both in case of zero rated supplies and inverted tax structure. Refund arising on account of refund voucher. Refund on account of wrong classification. Excess balance in the cash ledger. Refund claimed by unregistered recipient. And then refund of IGST paid on export of goods not supplies to SEZ. Whenever we are making supply to SEZ, we will pay IGST and we will claim the refund of that IGST under option 1. In that case, should we prove unjust enrichment? Yes. Only in case of export of goods or services, they gave the relaxation that we don't have to prove unjust enrichment. So this area can be asked as a short note question. What are the situations where refund is subject to unjust enrichment, or refund subject to unjust enrichment is not applicable in the following cases, like that? So we need to write the answer related to this. Then consumer welfare fund. So whenever we fail to prove that the refund is subject to unjust enrichment, then it will be transferred to consumer welfare fund. If the applicant fails to prove that there is no unjust enrichment, refund due shall be credited to consumer welfare fund. Any income from the investment of such amount credited to the fund is also deposited into that fund. They will appoint a committee for the purpose of utilization of that fund. Any amount having been credited to the consumer welfare fund, ordered or directed as payable to any claimant by orders of the proper officer, or even appellate authority can also order for the purpose of paying money out of the consumer welfare fund or tribunal or court, and that shall be paid from the fund. Then interest on refund. So whenever there is a refund application that is made, within 60 days the refund should be granted. If not, the interest will be payable at the rate of 6% per annum. On expiry of 60 days, that is from 61st day, the interest will be computed. Whenever we pay interest to government, it is 18% per annum. Whenever they give interest to us, it is 6% per annum. But in customs, whenever we pay interest to government, it is 15% per annum. Whenever they give refund to us, it is 6% per annum. That is common, whether it is GST or customs. But when we pay, it is different. In case of GST, 18. In case of customs, it will be 15%. And then if refund arises from an order passed by the adjudicating authority, appellate authority, or appellate tribunal or court, the rate of interest will be 9% per annum. That will be taken as the rate of interest. Then next, this is the refund process. First, a person will make the refund application. The refund application should be made within 2 years from the relevant date. The relevant date will depending upon the situation. And once the application is made within 2 years, in the RFD 1, within 15 days, the proper officer will verify and will either generate acknowledgement or will give a deficiency memo. If he gives deficiency memo, again the rectified refund application needs to be filed, but the period from the date of deficiency memo till the date of fresh application will not be counted. So I mean, like from the application within 15 days, that will be counted, but they give the deficiency memo. Thereafter deficiency memo we will file, so that period will not be counted. So therefore verification will be done by the proper officer. If it is valid in all respects, then acknowledgement will be generated in RFD2, and in that acknowledgement they will specify the date of application, because when we submit the revised application, that revised application date only will be taken as the date of refund application for that reason. And once acknowledgement is generated in RFD2, if it is refund on account of zero rated supplies, within 7 days there is a provisional refund that will be granted, and that provisional refund will be 7 days from acknowledgement date, not 7 days from application date. 7 days from acknowledgement date, a provisional refund order in RFD4. How much is the provisional refund? That is 90% of the total refund claim. So payment order will be RFD5. So 90% of refund claim, either it will be given to the consumer welfare fund or it will be credited to the bank account of the applicant. If they fail to prove unjust enrichment, then it will be credited to consumer welfare fund. You may get a doubt, sir, in case of zero rated supplies, no need to prove unjust enrichment, right? Then why there is credit to consumer welfare fund? There is. In case of refund of unutilized ITC, no need to prove unjust enrichment. But in case of zero rated supplies upon payment of IGST, in that only for export, no need to prove unjust enrichment. But in case of supplies to SEZ, so this actually supplies to SEZ. In case of supplies to SEZ, we need to prove unjust enrichment. If we fail to prove unjust enrichment, the money will be credited to consumer welfare fund. But otherwise, in the other cases, that is export upon payment of IGST or refund of unutilized ITC, in those cases, no need to prove unjust enrichment. So it will be credited to the bank account of the applicant. Then thereafter the refund with respect to other cases means the other points, refund on account of refund voucher or wrong classification or deemed exports, all other cases, or refund with respect to other cases, or balance refund in case of zero rated supplies, that is the remaining 10%, that should be paid within 60 days from application, not 60 days from acknowledgement. It is 60 days from application, means within 60 days any of these three things will happen. Either we will get a final refund order on RFD6, or we will get adjustment against liability order RFD7, or we will be getting notice for rejection in RFD8. Any of these three things we will be getting. So we will get a final refund order. that final refund order will be in RFD 6, or adjustment against liability order. In case there is outstanding demand against a person, the first and foremost recovery mechanism is that deduction from the money owed by the person. So therefore from refund they will take out. So that is his adjustment against the liability order. Or if there is any discrepancy, they will be giving a notice for rejection in RFD 8. Within 15 days, we need to give reply to the notice, and thereafter proper officer is satisfied, then they will pass the final refund order. Otherwise, refund rejection order in RFD 6. So RFD 6 will be final refund order or refund rejection order. Once the final refund order is passed, then again either it will be credited to consumer welfare fund or credited to bank account of the applicant. If they fail to prove unjust enrichment, then it will be credited to consumer welfare fund. Otherwise, it will be given to the bank account of the applicant. This is the refund process. So the time limits and what will happen, etc. So these are the things which you need to remember. Even if you are not remembering the forms, refund forms, that is fine. But the time limits and the process you need to focus. And provisional refund will not be granted. So provisional refund will be 90% in case of zero rated supplies. That will not be granted if the applicant was prosecuted for an offence, any offence, where the tax evaded exceeds 2.5 crores. So tax evaded means GST, the total tax. The total tax evaded exceeds 2.5 crores during any period of 5 years preceding the refund period. In the last 5 years, he has committed an offence where the tax involved in that offence is, total tax involved in the offence is more than 2.5 crores. Then in that case, he will not get provisional refund. So he will get only the final refund. Then the procedural aspects, the application for refund in all these cases will be RFD 1. But in case of refund to UIN holder, it will be RFD 10. So application for refund RFD 1, and in case of refund by UIN holder RFD 10. Whereas in case of export of goods upon payment of IGST, under that option, export of goods upon payment of IGST option, the customs officer will process the refund application. So shipping bill will be taken as a refund application in that case. And Aadhaar authentication is mandatory for filing refund application. The time limit for refund application is 2 years from the relevant date, while computing the period of 2 years. Period from the date of filing refund claim till the date of communication of deficiencies, that will be excluded. For example, we are making the refund application on 5th of December, and thereafter on 10th of December we got the deficiency memo, and again we made the refund application, new refund application. Now what they are telling, so from the date on which you file the refund claim initially, that is 5th December, so till the date of communication of deficiencies, so that will be excluded. Okay. And time limit of 2 years is not applicable in case of refund of excess balance in the cash ledger. That is an exception. Time limit is not at all applicable in that case. Even beyond 2 years or 3 years also we can make the refund application. What is the relevant date for computing the 2 years time limit? Suppose if it is export of goods. So whenever there is export of goods, the date on which goods leave the country, that should be taken from there within 2 years. So they should be, claiming the refund. So therefore they should make the application. Remember, export of goods, let it be option 1 or option 2, the date on which goods leave the country. In case of export of services, option 1 or option 2, the date on which you receive the money or the date on which you raise the invoice, whichever is later, not whichever is earlier. For payment of tax it is whichever is earlier, but for claiming refund it is whichever is later. Okay, so therefore invoice date or payment date, whichever is later. In case of deemed export, the actual date of GSTR 3B by the supplier. Whereas in case of supply to SCZ or inverted tax structure, it is due date of 3B. Usually we get confused between these two. Deemed export, it will be actual date. Remember here D came, so actual date will come. And whereas in other case, it will be due date of GSTR 3B. So here D, so not due date. Okay. So that should be remembered, because this is the place where we get confused. Refund on account of judgment. So the date of judgment. Refund on account of provisional assessment, whenever the final assessment has happened. Refund by recipient, the date of receipt of goods or services. Refund by unregistered recipient, the date of cancellation letter by the supplier. In any other case, the date of payment of tax. So this should be taken as the relevant date. In MCQ they will test this. So they will be asking what is the time limit by which refund application should be made. 2 years but if you add the 2 years from every date given in the question, you will end up with the options. So therefore, without knowing this provision, you will not be able to answer the correct answer. Then withholding of refund. When withholding of refund, if there is any outstanding demand against a person to whom refund is payable, then such proper officer can pass an order for withholding of refund. And when proper officer or commissioner is satisfied that the refund is no longer liable to be withheld, he may pass an order for release of withheld refund in prescribed form. and first they need to pass the order for release of withheld refund, then only pass the sanction order, because the demand order is outstanding. When the demand is outstanding, so the recovery process will be taken. So till that point of time they will withhold the refund, and if the person discharges the liability, then this refund will be released to that person. Suppose if the person is not at all paying tax, after 3 months from the demand order, so this refund will be adjusted towards the liability. And refund in case of zero rated supplies, that is in case of exports, so there are two options. So first he will pay IGST and claim refund of the tax paid, and government notifies certain goods on which refund cannot be claimed. So there are some goods on which refund cannot be claimed, notified goods like pan masala, tobacco products, etc. Also one more case, whenever you are exporting upon payment of customs duty, you will not be able to claim the refund under this option 1, and whenever you are going for refund under option 1 export of goods, first you need to file a shipping bill. That shipping bill will be processed by the customs officer and he will sanction the refund. So thereafter we will get the refund into our electronic cash ledger or into our bank account. But here the customs officer will verify whether the goods are really exported. So therefore the person in charge of the conveyance will be filing export manifest or export report or departure manifest. That departure manifest or export report should contain the details of our shipping bill which are being exported, means the goods should be really loaded, and that is the first verification. So after verifying that, the second thing that the customs officer verifies that is that there is a custom like IGST that is paid on this export of goods. For that they will be verifying our GSTR 3B. So after verifying our GSTR 3B, they will come to know yes, it is export of goods upon payment of IGST. So they will sanction the refund in this case. These are the two conditions, and previously we had this point, but this point is at present not applicable. So you will not be tested with this. So this is only for the short term period, and now they have made this amendment in rule 96 itself. So this will not be tested. What is this point about simple pa? That is, previously you have imported the goods without payment of any customs duty and GST, and whenever you are importing without payment of anything, then at the time of export, actually the correct option for you should be export without payment of any GST. But if you go for export with payment of a GST, then you will not get the refund, because on imports you don't have any burden of tax. Means first of all you don't have any burden of tax, and where from you will be getting the refund. So for to just reverse that point, what they are telling, at the time of import you did not pay anything, now you pay basic customs duty, social welfare surcharge, whatever is there, that you pay, because at the time of import you did not pay that. Now you pay, so that at the time of export whatever IGST you have paid, that we will get as a refund. But at the time of import you did not pay, so now you pay along with the interest. That interest will be at the rate of 15% per annum. That is this. If goods are imported without payment of customs duty including IGST or GST compensation cess, refund of IGST paid on export is not available. However, if only basic customs duty is exempted but IGST or compensation cess is paid, the condition is not violated and refund available. So if initially goods are imported without payment of IGST or compensation cess but later paid along with interest, refund of IGST on export shall be sanctioned provided reassessment of bill of entry is completed under customs. Then next, so only basic customs duty is exempted, no issue, but definitely what should have been paid? IGST and compensation cess should have been paid. And in case of, but this IGST and compensation cess is under customs, not under GST. Then in case of supplies to SEZ, the supplier have to file the refund RFD 1, and whenever they are making supply to SEZ, they need to get the certificate from the SEZ officer that really these goods are like supplied to SEZ in relation to their authorized operations. So then only they will be able to claim the refund. So then the proof of receipt of goods or service as evidenced by the specified officer of the zone is the prerequisite for filing refund claim by the DTA supplier. And this table you see, whenever you are making export of goods, supply of goods, if it is taxable goods, then shipping bill plus export invoice is required if it is upon payment of IGST. And suppose if it is a refund of unutilized ITC, so then also it is required. Documents are required because you are exporting goods now. When you are exporting goods, definitely shipping bill is required, export invoice also required. Whether you go for first option or second option, first option will be on payment of IGST, second option will be under bond or LUT. But when you are exporting the exempted goods, definitely option 1 not possible, because on exempted goods we cannot pay IGST. Naturally only option 2 is available, refund of unutilized ITC, and here also shipping bill plus bill of supply required, but bond is not required, there is a relaxation. So no bond or LUT as per the circular. Whereas services, when you are exporting, If it is taxable services, export invoice is required. Both the options are available. But when it is exempted services, only option 2 is available. Option 1 is not possible because we cannot pay IGST, and here bond is required. Only for exempted goods, bond is not required, but for exempted services, bond is required. And in case of exempted, the document will be bill of supply instead of tax invoice. And next one, refund of unutilized ITC. There are two cases where you will get refund of unutilized ITC. This is a very important area. So number 1, refund on account of zero rated supplies. And here we need to see the formula for refund. The refund formula will be maximum refund equals to net ITC into zero rated turnover divided by adjusted total turnover. So what is taken as net ITC? ITC availed, only eligible matched ITC. So which means not reflected in 2B should not be taken. These are the key points. Please keep this in mind. There are a number of questions. From that only I compiled all these points and I am discussing with you. So suppose if it is not reflected in 2B, don't take that. If it is reflected in 2B, but it is blocked ITC or used for non-business purpose or used for exempted outward supply, then you should eliminate that because they are using the word eligible matched ITC. And what if there is inward supplies partly used for taxable, partly used for exempted? Whether D1 and D2 we need to reverse? No, D1 and D2 should not be reversed. Actually this will be C1. C1. What is C1? ITC availed in GSTR 3B, that is total ITC minus T1, T2, T3. Only 3 things should be excluded. First you need to take the matched ITC, blocked ITC, inward supply used for exempted outward supply, and inward supply is used for non-business purpose. Those 3 things only should be taken, and the remaining ITC, that remaining ITC will be called as the net ITC only with respect to inputs and input services. So be careful, they will be giving exempted turnover and taxable turnover. So don't reverse the ITC for exempted turnover and then take net ITC. So before D1 and D2, whatever you get, that should be taken as the net ITC. Then zero rated turnover, adjusted total turnover, and in net ITC, inputs and input service only should be taken, that too during the relevant period. What if I have some opening balance carried forward from the previous month? Will that be taken into the formula? No. Only those inward supplies which are purchased during the tax period for which we are claiming the refund will be taken. Then zero rated turnover means turnover of zero rated supply of goods or turnover of zero rated supply of services. What will be taken as the zero rated supply of goods? First we need to take what is the value of the goods that is declared in the invoice. Number 2, what is the FOB value declared under customs. Number 3, 1.5 times the similar goods sold in the domestic market, whichever is lower should be taken. Number 1, value declared in the invoice. Number 2, FOB value declared in the shipping bill under customs. Number 3, 1.5 times the similar goods sold in the domestic market, whichever is lower should be taken as a value in this case. Then in case of zero rated supply of services, you have to take it based on the payments received. First you need to take what is the payments received during the particular tax period. From these payments you take advances which is pertaining to the earlier tax period, that you need to add. Here you should not deduct, because based on advance we cannot claim the refund. We can claim refund only based on actual supply. So due to that reason, last period we would have received some advances that we would have deducted at that time, so that we need to add now. So don't deduct. So this is literally opposite to composition scheme. In composition scheme what we will be doing is that, so those advances which we have received in the last period, we will deduct it from the bill of supply. But here you should not deduct, you need to add. So because at that time we would not have claimed refund, so we need to add. So therefore payment received during the period plus advances with respect to which supplies are made during the period but received in the prior period, plus this month or this tax period we would have received some advances for which we will make supplies in future, so that should be taken out from this payments. But in composition scheme what we will do is that we will add that, because advances we need to pay tax. So simple, while paying tax add, because on advance also you need to. But in case of refund, no, on advance you cannot claim refund, so deduct. Exactly opposite treatment. Okay, so value of zero rated supplies made without payment of IGST, payment received during the period, minus advances with respect to which supplies are not made during the period, plus advances with respect to which supplies are made during the period but received in the prior period. And what is adjusted total turnover? Adjusted total turnover will be turnover including turnover of zero rated supply of goods and zero rated supply of services as defined above, minus exempted supplies. Exempted supplies will not be taken, but in this regard only one important point I told you, interest on loans, advances, deposits, even though it is exempted but should be taken into aggregate turnover, that is adjusted total turnover, because we need to determine this turnover for the purpose of ITC purpose. So therefore interest on loans, advance deposits, even though exempted but treated as taxable for ITC. So that should be added here, and all other exempted supplies should be taken out. Then we have maximum refund in case of inverted tax structure. In case of inverted tax structure, we have a formula: net ITC into inverted rate turnover divided by adjusted turnover minus net ITC into tax on inverted turnover divided by ITC on inputs and input services. So total we need to get 5 numbers in the question. Number 1, you need to get net ITC. First one, you need to get net ITC. Number 2, you need to get inverted turnover. Number 3, you need to get adjusted total turnover. Number 4, you need to get tax on inverted turnover. Number 5, that is ITC on inputs and input services. So first one is net ITC. First one is net ITC. Second one will be inverted turnover. Second one will be inverted turnover. Second one is inverted turnover. Third one will be adjusted total turnover. Adjusted total turnover. And 4 will be tax on inverted turnover. Tax on inverted turnover. Okay. And 5, last one is ITC on inputs and input services. ITC on inputs and input services. So we need to have these 5 numbers: net ITC, inverted turnover, adjusted total turnover, tax on inverted turnover, ITC on inputs and input services, and the refund will be simple. The refund will be equals to 1 into 2 by 3. 1 into 2 by 3. So you get the logic of how much of the ITC is pertaining to inverted turnover minus we need to take 1 into 4 by 5. What is that 1 into 4 by 5? That logic is simple. Out of that ITC, how much of the ITC is pertaining to only inputs? Because in this net ITC, you should take only inputs ka ITC. You should take only inputs ka ITC, and you should not take input services. Whereas in case of zero rated, that is exports or zero rated, we used to take in net ITC both inputs and input services. But in case of inverted tax structure, in case of net ITC, we should take only inputs, but input services should not be taken. And therefore, here what will happen? 1 into 4 by 5. So that is, out of this net ITC, how much is pertaining to inputs and input services, that proportion you need to see. Out of that, how much tax you are going to pay. So 1 into 2 by 3 minus 1 into 4 by 5. So this will be taken as the refund in case of inverted tax structure. So total these 5 numbers, if you get from the question, it is simple. You remember this way, you can arrive at the answer. So net ITC, inverted turnover, adjusted turnover, tax on inverted turnover, ITC on inputs and input services. And in net ITC, we should take only inputs, and we should not take input services or capital goods. But in the 5th point, we should take ITC on inputs and input services, but we should not take capital goods. And adjusted total turnover meaning is same as before, whatever we have computed. So net ITC availed only on inputs, but not on capital goods or input services. Meaning of adjusted turnover same as above. And whenever you are making export on payment of duty, refund under both the options is not available. Applicability of inverted tax structure to merchant export. Merchant export means I am manufacturing goods, I am not exporting, and you are the person who is exporting the goods, because I don't have the trade license. So you have the trade license. So I will be giving the goods to you and you will be exporting it. So literally, actually I should get the benefit of the raw materials, etc. and all. For that purpose, the law says that whenever you are making sale to merchant exporter, you charge to merchant exporter 0.1%, so that it will become inverted, because my outward supply will be 0.1%, definitely my inward supply will be more than 0.1%. So because the rate will be 5%, 12%, 18% like that, so it will be an inverted tax structure. What is inverted tax structure? The tax rate on output is less than the tax rate on input, so that is an inverted tax structure. So therefore, whenever I am making sale to a merchant exporter, I will be charging 0.1%, and it will become inverted turnover for me. So I will be able to claim the refund of unutilized ITC on account of inverted turnover on my purchases, and you will be charged with 0.1%. That 0.1% you can take ITC. You are exporter, merchant exporter. That 0.1% you can take ITC. Now you export without payment of IGST option, so that this 0.1% what you paid also you will get it as a refund. Okay. So say this: merchant exporter exports to third parties. Sale of goods to such third party by the supplier taxable at 0.1%, CGST 0.05, SGST 0.05 and IGST 0.1%. Such supplier making supply to such third party can claim refund of unutilized ITC under inverted tax structure formula, and such third party can avail ITC of such 0.1% GST paid on inward supply. So that is merchant exporter can take that 0.1% as ITC and should export goods within 90 days from the date of purchase invoice. That is important condition. Within 90 days they need to make the export. Within 90 days from the date of purchase invoice, only under bond or illuty without payment of IGST. So it should not be upon payment of IGST. So whenever they give this situation, be careful. As a merchant exporter, we procured like that, they will give, and the rate of GST will be given as 12% like that. So therefore on that procurement we will take 12%, but be careful, on that procurement we need to take only 0.1%, that to IGST only we need to take. Okay, so 0.1% is IGST. Suppose if you procure within the state, it will be 0.1% divided by 2. Okay, 0.1% divided by 2 means 0.05% CGST, 0.05% SGST. Be careful, there it will be twisted. Already they have tested this. In November 24 exam they have tested this. So it is possible that again they will be asking this. Then it will not be given as a standalone question, but as adjustment in that first question they will be giving deemed exports. Deemed exports, section 147 of CGST Act, which says that whenever there is a person who is making sale to AA holder, advance authorization holder, or EPCG holder, or even EOU, EHTP, STP, etc., then for the supplier it will be deemed export. We don't have services in deemed export, only goods are there. Even supply of gold by a bank or PSU against advance authorization is deemed export. That is anyhow covered in the first point. So you need to remember, sale of goods to advance authorization holder. Advance authorization holder under FTP is a person who can import the goods without payment of customs duty, or they can locally procure without payment of GST. So when you procure it from me, so that will be deemed export for me. Same way, you are a EPCG holder, you can import the capital goods without payment of customs duty, or you can locally procure the capital goods without payment of GST. So whenever I am making sale to you, for me it will be deemed export. And next, you are a EOU, etc. EOU, EHTP, Electronic Hardware Technology Park, STP, Software Technology Park, or BTP, Biotechnology Park. You can import the goods into your unit without payment of customs duty, or locally procure without payment of GST. For you, if I supply, for me it will be deemed export. I have two options. So what are the two options? Number one, I will be charging GST to you. When I am charging GST to you, so you will take that GST as ITC and you will claim the refund. Entire, no formula here. The difference between that point and this point is that, so there also exporter is there, here also you are an exporter, but only difference is that you are a AA holder, EPCG holder and EOU holder. So what you will do is that when you are exporting under the zero rated supply model, you will take net ITC into zero rated by adjusted turnover. But in this case, you will not take any formula like that. Fully whatever GST paid on inward supplies from me, you will take ITC and you will get the refund of that entire ITC without any formula. That is this. So supplier shall recover GST on outward supply and pay GST, and the recipient, you are the recipient, you are a AA holder, EPCG holder or EOU, you will take ITC and claim refund of GST paid to the supplier. Recipient can avail ITC even though blocked ITC. See, one more advantage is there. Full refund you will get of that ITC. Even blocked ITC also you can take. If there are some inward supplies which are usually blocked ITC, that also can be taken under this particular option. Another option is there where I will not charge any GST to you, which means your burden will become zero. So first of all, I am not taking GST from you. So supplier shall not recover GST on outward supply and pay GST by utilizing. So I will only pay GST to government. I will not collect anything from you. I will pay out of my pocket, and whatever I pay, I will get it as a refund. So why should I pay and get it as a refund? While paying, I can pay using credit ledger or cash ledger, but fully it will be reflected in my bank account. That is the advantage, and get refund of gross GST. Advantage is that ITC is converted to electronic cash ledger. Then, in respect of supplies regarded as deemed export, either recipient or supplier are allowed to file the refund application. The supplier can seek refund only in case where the recipient does not avail ITC on such supplies and furnish undertaking to the effect to claim the refund. And what is the difference between deemed export versus merchant export? In case of merchant export also, I am making sale to an exporter. Deemed export also I am making sale to an exporter. But what is the difference between these two? In case of merchant exporter, you are the merchant exporter, you don't have advance authorization, you don't have EPCG, you don't have any EOU scheme, etc. You are a normal exporter. When I make sale to you, that will be coming under sale to merchant export 0.1%, only that model. Whereas in case you are having any of these three, advance authorization, EPCG or EOU, then when I am making sale to you, for me it is deemed export. So I have two options. What are that? Either I may not collect GST from you, or I will collect GST from you. Like the two options are there. if I am not collecting GST from you, I will claim refund. I will pay and I will claim refund. If I collect GST from you, you will take ITC even though blocked ITC and you will get as the refund. That is the difference between these two. Next, refund on account of wrong classification. So whenever there is a wrong classification, that is intrastate supply is subsequently held to be interstate supply and vice versa. First we need to pay the correct tax. For example, intrastate supply, so it is CGST, SGST paid, but actually it is interstate supply. So pay IGST and get refund of the wrong GST paid. So within 2 years from the date of payment of correct tax, you need to make the refund application in RFD1. Refund of wrong tax paid not available if the taxpayer has made tax adjustment through issuance of credit note under section 34. What if I have already rectified it by giving a credit note? In that case, this particular point is not applicable because already I rectified and I collected the correct tax from the recipient and I paid it to the government. So because the credit note adjustment I have done, and refund shall be credited to the source ledger. Suppose if there is any excess payment of tax, that excess payment of tax is by mistake, then that may be paid partly from credit ledger, partly from cash ledger. So whenever the refund is sanctioned, the refund will go to the source ledger. So from where the wrong tax has been paid in proportion to the payment made during a tax period, and unjust enrichment is not applicable in this case. So that is in this case, because we have seen some cases where unjust enrichment is not applicable. In that, one of the situation is refund on account of wrong classification. Then this is refund to UIN holder. There are some specialized agencies of UN like UNESCO, UNICEF, etc., embassy or consulate which is located in India. Their outward supply will be exempted on their inward supply. So whatever goods or services that they are procuring within India, they will pay the sale price plus GST on their inward supplies. Outward supply is only exempted, but inward supplies is not exempted. On that inward supply, whatever GST they paid, that GST supplier will pay to government, and from government they will be able to claim the refund. And even on import of goods from a supplier located outside India, when they import the goods, so they will be paying customs duty along with IGST, and whatever IGST that is paid, that also they will be able to claim as a refund. And what about import of services? First of all, on import of services, they will not pay any GST because, so import of services, they need to pay GST under RCM, and section 24 they are compulsorily required to get registered, but as their outward supply is fully exempted, they are exempted from registration. IGST not payable on import of services as section 23 overrides section 24, and in this case what is the refund application? RFD 10. Along with that, they have to file GSTR 11 that contains the details of all the inward supplies. UN of the recipient should be mentioned in the tax invoice issued by the supplier. Suppose if it is not mentioned, then refund available only if copy of the invoice attested by the authorized representative of the applicant is submitted along with refund application. Then acknowledgement shall be made available in RFD 2, and inward supply should have been received against a valid tax invoice, and the refund application should be filed within 2 years from the last date of the quarter. In this case, the relevant date is the end of the quarter. So end of the quarter, within 2 years the application should be made. Refund not allowed with respect to a single invoice where the value is less than 5,000, not equal to 5,000, less than 5,000 excluding the tax. And once the refund application is made in RFD 10, as usual, within 60 days, the refund order will be passed in RFD 6. And here there is one important point which you should know, that is usually what is the maximum refund that the person will be eligible. So in case of refund of unutilized ITC, either the refund as per formula or the balance in ITC at the time when you make application for refund, or the balance in ITC for the month for which you are making refund application. For example, July 2023, you are making refund application now. So July 2023, what was your ITC balance that will be taken? And during July, what are all your inward supplies of inputs and input services for which you are claiming refund? The formula should be taken. And today, when you make the refund application, what is the balance of ITC should be taken? Whichever is lower is what you will get as refund. Refund of unutilized ITC is least of the following, that is a refund as per formula or balance in credit ledger, which month? In the month for which refund claim is filed. In the month for which means the month for which we are claiming refund, what was the balance in credit ledger, and what is the balance in credit ledger at the time of filing refund application. Today you are filing refund application, what is the balance in ITC? Whichever is lower you will get as a refund. So first you need to do the computation of the formula. After computing the formula, you need to check for the balance, and that much only you will be getting as a refund. So don't forget this point, it will not be explicitly asked in the question, but you need to do this exercise. Then applicant may at any time before issuance of provisional refund order or final refund order or payment order or withhold order or show cause notice. That is, before taking any action against your application, the application can be withdrawn for refund. The moment they do any of these things, either final refund, provisional refund or notice etc., means they have taken up the application. Now you cannot withdraw the application. This is about withdrawal of refund application. So we completed all the points related to refunds. And one more point which usually will be tested in exam is that in that inverted tax structure, they will be giving that there are some 4 inputs, and out of that 4 inputs, one input only will be inverted. So not everything. For example, my outward supply is somewhere like 12%. My outward supply is 12%. All the inputs will be 12% or it will be less than 12%. But only one input will be 18%. So what is inverted? The tax rate on output is less than the tax rate on input. Only one input. Even then, should we take all the inputs in the net ITC? Yes. Even if one input is only inverted, means only one input rate is more than the output car rate, but all the inputs should be taken into the computation of net ITC. This is one point. Then one more point, whereas there are some notified goods. For example, say this, I have input A, B, C, D pa. Input A is 12%, input B is 18%, input C is 5%, input D is again 12%, and all these things is used for FG, and that FG will be 12%. Now tell me in this which is inverted. A is not inverted, B is inverted, because what is inverted? The rate of GST on output is less than the rate of GST on input. That is only called as inverted. So A not inverted, but B will be inverted, C is not inverted, D is not inverted, only B is inverted, correct or not? Now you need to calculate the net ITC into inverted turnover by adjusted turnover in the formula. In that net ITC, will you take only B ka ITC or all the ABCD as the inputs? All the ABCD. Even though one input is inverted, all the inputs should be taken. Don't forget this point, it's a very important point. Then there will be some negative list. That is, they will be telling in some cases refund of unutilized ITC is not available like that. So in some cases, so whether we will take that into account? No. For example, we are purchasing the garment in cloth. We are purchasing the cloth, and using that cloth we are making the garment. Actually on cloth the rate of GST 18%, on the garment it will be 5%, even though it is inverted, but this cloth is notified as the goods for which refund is not available, which means we will not be able to claim the refund. One more point, suppose if we are purchasing raw material X, using that we made finished goods Y, this finished goods Y is nil rated, and the raw material X will be 12%. Will it come under inverted? No, it will not come under inverted, because finished goods Y is exempted or nil rated. It will not come under inverted, because anyhow when it is exempted or nil rated, you cannot take ITC na. Where is a question of refund in this case? So refund will not be available in this case. Got it? And next one more case, that is you are purchasing one product. Say for example product X, and product X, the rate of GST is 12%, but when you are making the sale, so first you are purchasing product X 12%, you are making sale. At the time of sale, same product X you are making sale, at the time of sale it came to 5%. How the rate will come down? Because the same product, depending upon the sales, it may change. So normally product X 12%, but when you are selling this product to defense, the rate may be less. So therefore because of that reason the 5% has come, or at the time of purchase it was 12%, there is a change in rate, because of the change in rate it came to 5%. Will it be counted as inverted even though it is the same product? Yes, even though it is the same product, still it is counted as inverted turnover only, because the rate of tax on output is less than the rate of tax on input. Okay, all these are through some illustrations which I just gave you these points. Then so we completed assessment, audit, demand, recovery, offences, penalties, all those things, appeals, advance ruling, and look into ethics and other provisions. The last area in GST, page number 218. So what is the role of CAs in ensuring ethics under GST? It's a theory question. So it may be tested in exam, maybe or may not be, we don't know. And this is your auditing paper, okay. So code of ethics, what are the fundamental principles to be followed for ensuring ethics in GST? So the CA should have professional behavior, BICOP, remember BICOP, B for professional behavior, they should exhibit professional behavior, and they should be having integrity and confidentiality, they should not share the client's information with anyone else, and they should be transparent. That is what integrity they are telling, and objectivity. They should not deviate from the object with which the client service is to be provided, and professional competence. From time to time they should be updated with the laws and regulations, and they need to exhibit professional competence. So this is what fundamental principles to be followed in ethics under GST. Disciplinary action on CA for not following ethics. Under GST law, what is the penalty? Either penalty under 122 subsection 3, that is, he is just a party to the offence, then up to 25,000 under each act. Suppose at his instance, or he is the beneficiary of the offence. Which offence? Invoice default, ITC default, ISD default, 3 I's. So he, at his instance, the offence is committed and is the beneficiary of those offences. Then 122 1A, which is nothing but 100% of the tax evaded or ITC passed on, that will be taken. And 125 general penalty may be applicable up to 25,000 rupees plus imprisonment under 132, under which grounds? Attempt to commit or abetting commission of the offence. Under that ground there will be imprisonment also. This is under CGST Act. Whereas under ICA Act, they will be deemed to be guilty of professional misconduct, and if they are not exercising due diligence, grossly negligent, or fails to obtain sufficient information for giving an opinion or certification. So what will happen in that case? Either their name will be removed from the members and reprimand CA, and remove the name from the member either permanently or for a period of time, and the fine up to 5 lakhs. So this you need to write. So 1-1 is 1-1 theory question. Either they can ask this or they can ask this. Areas where CA has to ensure ethics in GST. So these are the 3 areas where they need to operate and should ensure ethics. First, related to advisory. Related to advisory, remember this mnemonic SURA. S-U-R-A. S for structuring the transactions, and U for understanding the client operations. Okay. So structuring the transactions means framing the transaction, and it should not be shady transaction in order to evade the GST. Number 2, understanding the client operations. Number 3, registration. They need to properly advise the client with respect to when they are required to get registered, etc., and assess the impact on the supply chain, pricing strategies, and financial reporting. So this is related to the advisory. Then compliance. What are the works that they do in compliance? TDS, TCS returns, normal returns, anti-profiteering, certifications. We have few certifications, na? So ITC1, ITC2, etc. That certifications. Then e-way bill and records, maintenance of accounts and records. Then in litigation, what is the work of CA? So they will appear before the GST officer or appear before the appellate authority or GST-AT. And these are all the areas where GST related work the CAs will do, and in those areas they should ensure ethics. Okay, first you remember what are the areas, what are the practice areas for CA, and in that they should ensure ethics. Like that you need to write. Then next one, what are the certifications by CA? So there are total 5 certifications. Number 1, form GST ITC 1 if the claim of ITC exceeds 2 lakhs. Number 2, ITC 2 in case of transfer of business, certification that the transfer of business is with specific provision for transfer of liabilities. Then ITC 3, that is to certify that the market value, if the invoice value is missing, if the invoice is missing, they will certify the market value at the time of reversal of ITC. And RFD 1, RFD 1 for what purpose? Certify that refund is subject to unjust enrichment if the refund claim exceeds 2 lakhs, and the special audit will be done by CRCMA. Apart from this, one more point we saw through circular. What is that? If the recipient is required to reverse the ITC because of the credit note issued by the supplier, and if the claim of that ITC reversal because of the credit notes against a particular supplier exceeds 5 lakhs in a financial year, then the CRCMA of the recipient should certify that they have reversed the ITC. That is also one of the point. So if you get a question, so write a brief note on certifications by CA in GST. You need to write these points. Then next one, section 144, presumption as to documents in certain cases. As per section 144, any document that is produced by any person under the CGST law or any other law, or seized from the custody or control of the person, or received from a place outside India in any proceeding, tendered by the prosecution. Tendered by the prosecution means when the department is submitting the document as a evidence against such person or any other person who is tried jointly with that person, the document is presumed to be evidence, and the person that is who is the case, the person who is the offender has to prove that the document is not correct. The onus of proof is always on the person who is offender, that is the taxpayer will have the onus to prove. So it is simply like that, like department will produce one document in the court of law and you cannot say that is not my document, that document I did not sign, etc. and all. Any document that is produced by them that you might have submitted or any person would have given to them or they would have got it from outside India, that document is presumed to be evidence and the person should prove to the contrary that it is not the valid evidence. Okay, the onus to prove is on the taxpayer. Next, modes of service of notice, section 169. These are the different modes. So either they will be communicating to his email address, or it will be uploaded in the common portal, or it may be registered post with acknowledgement due, or it may be publication in the newspaper circulating in that locality, or directly they will send it through a messenger including a courier. Any of these modes they can follow depending upon the situation. If the last login in the common portal is some 1.5 years before, so then it is not possible, because we know that when they have made the last login and email we are sending, but we get a mail delivery notice that so error, we could not deliver the mail like that, so this also fails, this also fails. Then RPAD, registered post with acknowledgement due, postmaster is calling and we are telling that no, that person is not available, I am not that person, so that is also gone. Then they will put it in the newspaper but no reply from us. They can directly also send through a messenger including a courier. Any of this method can be resorted. If all or any of the method is not possible, then they can display the same in their notice board, that is also deemed to have been notice issued. Then all department communication should have a DIN. So that is an amendment, because previously a lot of fake notices were coming to our mail and like they will be mentioning that you have this much of tax demand. Today if you pay, there is a 50% discount. Use this link to make the payment, like that and all. So that will be fake thing, but people don't know anything about it because everyone wanted to pay and come out of that. So 50% is better offer. So that's why they will pay. That's the reason why any department communication is now having a document identification number, and you can go to the portal and you can enter that document identification number to know the authenticity of this particular document. Then, however, DIN not required for communication generated and served through the portal itself. For documents which are downloaded from the portal, this is not required. Any documents which we receive over the mail only, this document identification number is required. Anti-profiteering, it is not there for your exam because anti-profiteering provisions are omitted. So now they have omitted this. You can see that in the next to next page, the provisions of anti-profiteering is not applicable from 1/4/2025. For your exam for Jan, all the changes up to June 30th is applicable. So due to that reason, with effect from 1/4/2025, they have omitted it, and therefore this anti-profiteering is not there for Jan exam. Moreover, now any new anti-profiteering case will not be accepted. So no new anti-profiteering case. The pending anti-profiteering cases will be heard by principal bench. Okay, new application is not accepted, and pending complaint shall be heard only by principal bench of GST 80. This much only what you need to remember for Jan exam. Then next one, disclosure of information by public servant. So there are some confidential informations. What are considered as confidential information? Any statement made, any statement that is made by registered person or any other person under the GST law, or the written statement means that is evidence. Statement means evidence, either oral or written or video, etc. That is a statement, and returns furnished. And for audit of tax receipts and refunds, that is any tax receipt documents, etc. we might be sharing for audit purpose, that, and record of evidence or record of any proceedings. This is the confidential information. They should not share with anyone. However, in some cases it can be shared by the officer in order to discharge their duties. So that is exception to this. Above confidential information can be disclosed in the following cases. For what purpose? For prosecution. Because the officer is going to file a case. At that time they have to disclose this information in the court. And for carrying out the objects of the class, that is, for carrying out the objects of the act. So to give the notice, in order to give the notice, so they need to send it to the concerned officer, because the concerned officer will give the notice. For example, if the amount exceeds 1 crore, so it is additional joint commissioner. So therefore the lower level officer has to share that information with the above officer in order to give the notice. That is to carry out the objects for notice or demand, and for court proceedings, for audit, that is for verification of tax receipts and refund, and for inquiry of conduct of officer, whether a lower level officer has properly done anything like revisional authority, then lawful exercise of the power for data entry. So we may share this data with the GST portal, people who are working in GST portal to do the data entry, and that is okay. And in the public interest, their names needs to be published in the newspaper. So then also the information, confidential information may be shared. So these are the exceptions. Already they have asked it at least 3-4 times in the past. Very, very important theory question. You need to read sometimes the theory question and go for the exam. So because, what will happen is that sometimes if you don't know any practical question where it is so tricky, etc. and all, at least the theory will help you. It is like you are going prepared to the battle with multiple weapons and multiple skills. Not that every skill you will be using just because you learnt it. So you are learning and using, and depending upon the situation you will use it like that, okay. Then consent based sharing of information, and one more piece of information which I wanted to share with you, that ICAI literally wanted to follow a inverted pyramid for the purpose of CA course, which means that foundation it should be very less, intermediate will be more, final pass percentage will be more. So that's how the entry they wanted to make it difficult. So stock clearance sale is happening right now. So therefore if you are managed to get 35 plus in any one paper, and if you are getting exemption, so they are going to push you, okay. So that is the trend which is happening. So ensure that at least in one paper you are getting the exemption, and in the other paper 35, 38 like that, they are giving grace marks and they are giving. So because I have seen many answer sheets in the recent wherein the marks was 38 but the student got 41, okay. Marks was 38, the student got 41. So superly he cleared, and the flip side is also there. So but the same student who got 40, they have put 39 in intermediate, okay. So I mean like that situation is also there for intermediate. At final level they are doing, which means that they might have felt how many years you will be. So therefore like clearance they might be doing. So that's the reason why. So JAN is a golden attempt. Don't miss that golden attempt. Little bit effort. Hardly it is 1 month only. So put that effort. So who knows you are going to clear. Definitely. Little bit push. So that is there. That is enough. And consent based sharing of information. Section 158A. This is like whenever you give the consent to share your information to the portal. So that portal will share the information with financial intermediaries like banks or like financial institutions or any agents, intermediary like loan agents, etc. To them the data will be shared. Every time you don't have to download the returns and you don't have to give it. So once you give the consent, automatically they will be able to grab your GST data, and they will know how much turnover you made, how much tax you reported, etc. That is known as consent based sharing of information. You are the user and you will give a consent to share the data. But remember to whom you need to give consent. There are only 2 approved people. One is account aggregators or public tech platform for frictionless credit. These 2 people are only allowed to grab the data from the portal and give it. So to these 2 people only you need to give the consent. And once you give the consent, these 2 will take the data from income tax or GST portal. So all these places they will be taking the data, but we are concerned with GST platform. They will take the returns and other information from the GST portal, and directly they will be sharing with the financial information user, that is banks or financial institutions, NBFC, personal finance management, wealth management, robo advisors, etc. They will share this information. That is this consent based sharing. Then following details of supplier or the recipient may be shared by the common portal. Registration particulars may be shared. GSTR1 3B annual return, documents uploaded during inspection, all this data will be open, they will be taking. Suppose if this data is misused by any financial intermediary user, like financial information user, any bank or any agency, etc., if misuses the information, government is not held responsible. No action shall lie against the government for sharing of information. If you don't want that, you don't share the information, okay. Don't take loan or don't do anything. You download, and whatever data they need, that only you give. You don't give outright full consent. If you give outright full consent, that will be irrevocable forever. That consent is given. So anytime they can grab the data from the portal. Then comparison of different provision as to rectification of mistakes. There are 3 places where we have come across rectification of mistake. Section 161. Rectification of mistake apparent on the face of the record, this is a general provision. Section 102, rectification of advance ruling. Section 113, rectification of appellate order. The nature of this 161 provision is that it's a general provision, and who will be making authority, like who is the authority for rectification? Any GST authority, including appellate authority, adjudicating authority or revision authority, and subject matter of rectification, any notice or order or certificate or document they can rectify. So how they will find the mistake? Either suo motu they can find, or you may bring it to their notice, or any officer can bring it to their notice. Suo motu brought to notice by officer or brought to notice by taxpayer. What is the time limit for bringing it to the notice? So 1 and 2, that is suo motu or brought to notice by officer, no time limit. But when you are bringing it to their notice, so it should be within 3 months from the date of communication, that is date of order or date of notice. Within 3 months you need to inform them, and thereafter arithmetical or clerical errors, no time limit for rectification. All other cases, 6 months from the date of order or notice, means I have only 3 months. First 3 months you have to intimate or you bring it to their notice. Thereafter 3 months only you have, because the overall time limit will be 6 months. In that 6 months they need to complete the rectification, otherwise they cannot do the rectification of mistake. And opportunity of being heard, yes, if the rectification has adverse effect, means it is going to increase the liability or reduce the ITC, definitely opportunity of being heard will be given. That is this 161, which is a general section for rectification of mistake apparent on the face of the record. Whereas section 1 or 2, rectification of advance ruling, this is specific provision which authority will do, only AR or ARR, and matter, subject matter of rectification is the advance ruling order. How they will be doing rectification, either suo motu or brought to their notice by other authority or brought to notice by the applicant or appellant. First case no time limit, but the second case and third case within 6 months from the date of communication it should be brought to their notice. But how much time they will take for rectification, no time limit, so they can take any time. Then section 113, rectification of appellant order, who GST80 will give the order that can be rectified, and finding of mistakes either suo motu or brought to notice by commissioner or brought to notice by appellant. In the first case no time limit, second and third case 3 months, here 6 months, here 3 months from the date of communication, and this is to bring it to their notice. Thereafter there is no time limit for them to do the rectification. In all these 3 cases, opportunity of being heard should be given before doing the rectification. Okay, if there is going to be any increase in the liability or decrease in ITC. These are the points we have in relation to ethics and other provisions, which are the core points, important points. We completed all those things, and quickly we will see there are some queries. For the purpose of refund under section 54, in case of unutilized ITC, the exempted supplies which we exclude from the adjusted turnover is calculated as per normal exempted supplies only. No sir, no, as per the meaning of exempted supply for the purpose of ITC. So for the purpose of ITC we have some exempted supplies na, that only should be taken in the denominator. Okay, I mean while excluding the exempted supplies. But here anyhow we will not take land, building, etc. and all, because that is not included in the taxable supply itself. We need to take the total turnover minus exempted supplies. Only one special point I said to remember. What is that? Interest on loans, advances, deposits, like that. If anything is there, that should be taken. Okay. Then suppose if they give other data, etc. and all, like sale of land, sale of building, transaction securities, you take that, because here net ITC related turnover is what we need to see. Total turnover should be based on the net ITC. Okay. Then next, another question. Not as per 17.3, no, we should take as per 17.3 only, because for net ITC. Addendum PDF for January 26, no addendum PDF, there is no amendments, which I already highlighted. Any material PDF for Mighty 50, yes. So tomorrow also it will go up to customs. So tomorrow I will give you the PDF for Mighty 50, and we will discuss that on Sunday. As I told you that Sunday we are having class, we will continue with that. Then, should a supplier making interstate supply of other than notified services through e-commerce operator need to compulsorily register? No. Supplier of services through e-commerce operator is not at all compulsorily required to get registered. They need to register only when aggregate turnover exceeds threshold limit. Also, if a person is having only SEZ unit, compulsory registration is required. Yes, because when you are having business only in SEZ, even though you are not required to compulsory register as per GST law, but the SEZ Act mandates that you need to get a GST registration there. Okay, so therefore that is required. That's what I told you. Even if you have business in DTA, but if you have a unit in SEZ, that SEZ unit you need to get a separate registration, and compulsorily you need to get registered with respect to that. Fine. So these are the queries. Now we are moving on to customs. In customs, so mostly the questions will be revolving around valuation, types of customs duty and baggage. And this time, so even the question can be asked on exemptions as well as import of goods at concessional rate of duty rules. Last attempt September 25, already they tested import of goods at concessional rate of duty rules. I was telling that it is an amended area. In customs only one amendment is there. You prepare and go for that like that, and it came. So this time I doubt they will be asking a theory question or a comprehensive question on that, but in MCQ they will be giving. So exemptions, because quite a long time, last 2 attempts they did not test, so on exemptions they will be making. So these are all the areas from which they will be asking, but we will discuss all the things. Taxable event under customs. First, we need to know the constitutional provisions. Customs duty is levied under entry 83 of Union List of 7th Schedule to the Constitution, and Customs Act contains a provision for levy and collection of customs duty. Customs Act is year 1962. Customs Tariff Act is year 1975. It contains a rate at which customs duty is payable on import or export, and government goods shall be treated on par with non-government goods. Even government is a person under customs, so even government is required to pay customs duty on import of goods like any other person. Like GST also, customs also, this is common point. Government is a person under customs. Then the taxable event. In case of import of goods, what is a taxable event? So the date on which goods cross the customs barrier will be taken as the taxable event. So when the goods are being brought into India, so in that case, the goods are under the control of customs. Whenever you file the bill of entry, the goods crosses the customs barrier, that will be taken as the taxable event as per Garden Silk Mills case. And if the imported goods are deposited in warehouse and cleared at a later point of time for home consumption, as the goods are deposited in warehouse, still the goods are under the control of customs. So whenever the goods cross the warehouse, then only it is crossing the customs control. So at that time only it is treated as import. So customs barrier cross when the goods are cleared from warehouse as per Kiran Spinning Mills case. So therefore as per Garden Silk Mills case and Kiran Spinning Mills case, only when the goods cross the customs barrier means customs control, it will be treated as import. Whereas we have two cases, Sun Exports case and Rajendra Dyeing and Printing Mills case, wherein in case of export, when the goods cross the territorial waters, then only it will be treated as export. So within territorial waters, if the ship has sunk, it will not be treated as export. That is these two cases when goods cross the territorial waters. And for the purpose of customs, India is up to 12 nautical miles, that is territorial waters only. For the purpose of GST, it is up to 200 nautical miles, but for the purpose of customs, it is only up to 12 nautical miles. When goods enter into 12 nautical miles, it is import. When the goods cross the 12 nautical miles, it will be export. Then levy, section 12 of Customs Act. So there are 4 conditions for levy of customs duty. There must be goods, and that goods must be dutiable goods. How do you know that the goods are dutiable goods? It should be covered under the Customs Tariff Act 1975, and that goods should be imported or exported, and that import should be into India or export from India. If all the 4 conditions are satisfied, then there will be levy of customs duty. And some important definitions. Goods. What is the meaning of goods? Goods includes vessel, vehicle or aircraft. If there is any vessel or vehicle or aircraft which is brought from outside India to India, and if that particular vessel, vehicle or aircraft is a foreign going vessel or aircraft, then it will not be leviable to any customs duty. But if that vessel or vehicle or aircraft is used in India for consumption in India, then customs duty is payable on that particular vessel, vehicle or aircraft, because that will be coming under goods. Same way, stores. Stores are the goods which are present inside the vehicle or conveyance for the purpose of consumption, whether or not immediately, like fuel, consumables, eatables, etc. Then baggage. Baggage refers to passengers' luggage. Currency and negotiable instrument. Currency and negotiable instruments is not goods under GST because it is covered under money, neither goods nor services, but under customs it will be treated as goods. So on import of currency, whether we need to pay customs duty? Yes, only basic customs duty and social welfare surcharge we need to pay, but IGST not applicable on import of currency because currency is not treated as goods under GST. Apart from this, any other kind of movable property. Then stores. Stores refers to goods for use in the vessel or aircraft and includes fuel, spare parts or any other articles or equipment whether or not for immediate fitting, that is stores. Then import. Import means bringing into India from a place outside India, and export means taking outside India to a place outside India. So this is a general meaning. And India, I told you, up to 12 nautical miles from baseline, and exclusive economic zone up to 200 nautical miles. Even though India is up to 12 nautical miles, but the powers of customs authorities extend up to 200 nautical miles, and like arrest and other seizure provisions etc. is applicable up to 200 nautical miles. High seas is beyond 200 nautical miles from baseline. customs area in every port or airport. Not entirely it will belong to customs. So wherever the customs officers is having the control, that is called as the customs area. The area under the customs station or warehouse and includes any area in which imported goods or exported goods are ordinarily kept before clearance by customs authorities. And Indian customs waters up to 200 nautical miles. So up to 12 nautical miles is territorial waters, and beyond 12 nautical miles and up to 24 nautical miles will be contiguous zone, and beyond 24 nautical miles and up to 200 nautical miles is exclusive economic zone. So up to, from the baseline, up to 200 nautical miles is Indian customs waters. Customs officer can execute their powers up to Indian customs waters, and beyond 200 is high seas. So that will be international waters, where all the bordering countries will have the equal right in international waters. Section 219, that is export goods. So goods which are to be taken. If it is already taken, then it is exported goods. Exporter means either owner of the goods or beneficial owner. Beneficial owner means they are not the owner of the goods. They are the owner of the goods, but they are not exporting. For example, I am the supporting manufacturer. You are the merchant exporter. I am the beneficial owner of that goods. So I am also exporter. And as you are only exporting it, so you are holding yourself as exporter, that is merchant exporter. You are also treated as exporter. Owner, beneficial owner, or any person holding himself out to be exporter. Then beneficial owner means on whose behalf the goods are being exported, on whose behalf the goods are being imported or exported, or who exercises effective control over the goods. Imported goods means brought into India from a place outside India. Again, importer, owner, beneficial owner, any person holding himself to be importer. If I am the owner of the goods, I am bringing it, I am importer. If I am the beneficial owner, but I don't have license to import, so I am asking you to import. So I am also importer, you are also importer. Suppose if anyone is not paying, we both are jointly and severally liable to pay the customs duty. Then baggage, it includes unaccompanied baggage but does not include motor vehicle. Accompanied baggage means which is brought by the person at the time when he is arriving to India, whereas unaccompanied baggage means either it is arriving before his arrival, either the baggage coming before his arrival or after his arrival, that is unaccompanied baggage. But baggage does not include motor vehicle. Coastal goods means those goods which are not imported or exported but moved from one port in India to another port in India, even though it is touching the sea waters, but still it is coastal goods within the port in India. Other than imported goods, transport in a vessel from one port in India to another port in India. And whenever the goods are imported, there are two options available to the importer. Option 1, the imported goods which are unloaded, either it may be cleared for home consumption immediately upon payment of customs duty. For that they need to file a bill of entry called as bill of entry for home consumption. At the time of filing bill of entry, they need to pay customs duty and clear that goods. This is option 1. Or option 2, they can deposit the goods in the warehouse. Which warehouse? Either public warehouse, private warehouse or special warehouse. These warehouses are licensed by the customs. In that place they can deposit the goods without payment of customs duty. But to deposit the goods in the warehouse, the importer has to execute a bill of entry called as bill of entry for warehousing or inbound bill of entry. Thereafter the goods will be kept in the warehouse without payment of customs duty. At a later point of time, importer can file ex-bond bill of entry to clear the goods from the warehouse upon payment of customs duty. That is this. So bill of entry for home consumption from the warehouse or ex-bond bill of entry. For depositing the goods in the warehouse, bill of entry for warehousing or inbound bill of entry. Without filing bill of entry, the unloaded goods cannot be cleared for home consumption or warehousing. Bill of entry, only when you file you can touch the goods. Until that point of time, that goods, even though it is yours, but you cannot take control over the goods, but you can do the examination. You can ask for examination of the goods. That is possible, but you cannot take control over the goods. Goods can be cleared to warehouse without payment of duty, but thereafter clearance to home consumption, from warehouse customs duty payable. And bill of entry should be filed before the date of arrival or after the date of arrival it can be filed, but it should be filed before the date of arrival. If it is filed on the date of arrival or after that date, a late fee will be payable. So time limit is before the date of arrival. If filed on the date of arrival or later, then late fee will be payable. And what is that late fee? For delay up to 3 days, 5,000 rupees per day. For the delay beyond 3 days, 10,000 rupees per day. For example, yesterday you should have filed a bill of entry, but you filed it after 3 days from today, means today also there is late fee, next 3 days also there will be late fee. Total 4 days, first 3 days it will be 5,000 rupees per day, so 15,000. For fourth day it will be 10,000, so total 25,000 will be taken as a late fee in this case, and the maximum late fee will be 100% of customs duty payable on that goods, whereas in case of exempted goods, the maximum late fee will be 50,000. So this late fee provision is in procedures. as clearance from warehouse is the taxable event. At the time of import and deposit into the warehouse, the goods are dutiable. At the time of clearance from warehouse, the goods became exempted. Are we required to pay or not required to pay customs duty? Not required to pay, because at the time of clearance from warehouse, the goods became exempted, vice versa. At the time of import, the goods were exempted. We kept it in the warehouse. At the time of clearance from warehouse, the goods became dutiable. Are we required to pay the duty? Yes, because clearance of goods from the warehouse is the taxable event. Customs warehouse does not mean the warehouse belonging to the customs department, but a warehouse which is owned by any person, which is licensed by the customs department to act as a customs warehouse. And an importer has his own warehouse for which he can obtain a license and convert his own warehouse as customs warehouse. Thereby, the imported goods can be kept in his own warehouse, no need to pay customs duty. At a later point of time, when he clears the goods from the warehouse for home consumption, I mean for manufacture, he can pay the customs duty and he can defer the customs duty payable till the time he uses such goods as clearance from warehouse is only the taxable event. And next, this warehouse is called as private warehouse. So for their own warehouse, they will get the license, that is called as a private warehouse. Public warehouse means goods belonging to any person can be deposited, imported and deposited, whereas private warehouse means only the warehouse keeper's goods can be imported and kept. Then various documents involved. In case of import, the three modes, vessel, aircraft or vehicle. What is the document to be filed by person in charge of the conveyance? Who is the person in charge of the conveyance? In case of vessel, master of the ship. In case of aircraft, pilot. In case of vehicle, driver, guard, etc. So therefore, what is the document to be filed by person in charge? In case of import by vessel, import manifest. In case of import by aircraft, arrival manifest. In case of import by vehicle, import report. What is the document to be filed by importer? Always it will be bill of entry. Then what is the document to be filed by exporter? So that is in case of export, what is the document to be filed by person in charge? Here import manifest, so export manifest. Arrival manifest, so departure manifest. Import report, so export report. And what is the document to be filed by exporter? Shipping bill. In case of vessel and aircraft, and in case of vehicle, it will be bill of export. Person in charge, master of the vessel, pilot in case of aircraft, and conductor or guard or any other person in case of vehicle. Only after filing, import manifest grant of entry inwards is given for the vessel to enter into India. But for the aircraft, we don't have the concept of grant of entry inwards. The concept of grant of entry inwards and the concept of grant of entry outwards is only for vessel, not for the aircraft. The grant of entry inwards is not applicable in case of aircraft and vehicle, but arrival manifest or import report should be filed before the arrival, and along with the bill of entry, importer has to submit that is, importer has to mandatorily submit some documents. What are the documents to be submitted? First, importer should submit a bill of entry to prove that he is the owner of the goods and this much is the customs duty, etc. But he also should prove that he is having the right to take the goods. So the document of title which is given by the carrier should be in his name, that is airway bill in case of aircraft, bill of lading in case of vessel, lorry receipt or railway receipt in case of vehicle to claim the ownership of the goods, and even an invoice which is raised by the person outside India to India on him, that should also be submitted along with the bill of entry and these documents. What is the relevant date for determination of rate of duty and exchange rate? In case of import, the relevant date for determination of rate of duty is the date of presentation of bill of entry or grant of entry inwards, whichever is later. In case of vessel, in case of aircraft, date of presentation of bill of entry or arrival, whichever is later. And here relevant date by vessel, date of presentation of bill of entry or entry inwards, whichever is later. But aircraft and vehicle, date of presentation of bill of entry or arrival, whichever is later. Whereas in case of option 2, that is imported goods cleared for warehousing, date of presentation of ex-bond bill of entry for clearance from the warehouse. Whereas in case of export, the relevant date for rate of duty is the let export order, which is passed by the proper officer permitting us to do the export. Whereas relevant exchange rate in case of option 1 import cleared for home consumption, only one bill of entry is filed. That bill of entry, whatever is the exchange rate, that will be taken. Whereas in case of warehousing, there will be two bill of entry. One for deposit in the warehouse, that is inbound bill of entry. Second one is to take the goods from the warehouse, that is export bill of entry. So which should be taken as relevant date for exchange rate, date of presentation of inbound bill of entry should be taken. Whereas in case of export, so it should be date of presentation of shipping bill or bill of export. Date of presentation of shipping bill in case of SLR aircraft or bill of export in case of vehicle, that is taken as the relevant document. And who should determine the exchange rate? Exchange rate as determined by CBSE should be considered. In case of improper imports or improper export, relevant date is the date of payment of duty, that is in case of smuggling. So whenever you are caught, on that day whatever duty that you are paying, that date only should be taken as the relevant date for rate of duty. Then next you can see exemptions under customs. So in this taxable event, the relevant date for rate of duty and exchange rate, that will be useful for ascertaining the rate of duty and exchange rate in the practical questions. Then exemptions, we have general exemption and special exemption. It's a theory question. There are two types of exemption that may be granted by the government under section 25 of Customs Act. General exemption means central government in public interest, they will give a notification official gazette, either exempt generally or absolutely or subject to certain conditions. And conditional exemption, for example, they will be giving valid up to 31st day, any conditional exemption that is given which is valid up to 31st March, falling immediately after 2 years from the date of such grant or variation in other than specified cases. For example, somewhere on 15th of October 2025, they gave the conditional exemption. What is its validity? Means like exemption will be valid with a sunset clause. What is that sunset clause? Means after that date this exemption will be invalid, that exemption will not be there. So 15th October 2025 means you count 2 years. What is 2 years? 15th October 2027. And what is a March falling after that? What is a March falling after that? That is 31st March 2028. So till 31st March 2028 this exemption will be valid. What will happen after 31st March 2028? Automatically this exemption will be removed. This is in case of conditional exemption. Then next, special exemption. Central government in public interest by special order in each case exempt from payment of duty only under circumstances exceptional in nature. So this special exemptions is in emergency circumstances and it will not be published in the official gazette. For example, no duty if the amount of duty leviable is equal to or less than 100 rupees. So this is one point is there. So if the duty is less than 100, not equal to 100, less than 100, then customs duty not payable. Power to grant exemption is given to government under section 25. Government by notification official gazette exempt goods from payment of customs duty either unconditionally or subject to certain condition. What is the effective date of this notification? It is not the date when it is published in the official gazette. It is the date when it is issued for publication. So date of its issue by central government for publication official gazette, say on 4th November, it is issued for publication, but it got published on 8th November. So 4th November will be taken as the effective date of the notification. Whenever they give exemption through a special order, the date of its issue is the date. Anyhow, it is not published in official gazette. Clarifications. So it may be issued within 1 year from the date of issue of notification. Any explanation that is added, this point is common in GST as well as customs. Any explanation that is added to the notification within 1 year from the date of notification will have a retrospective effect from the date of notification. If the explanation is added beyond 1 year from the date of notification, the date on which the explanation is given only will have the effect, that is prospective effect. So if it is issued within 1 year from the date of notification, it will have a retrospective effect. This point is common both in GST and customs. Then next page you can see. So we have various exemptions. In these various exemptions, section 13, which deals with no duty on pilfered goods. Pilfered goods refers to petty theft. So small thefts that happens when the goods are unloaded in the port or airport. Then section 13 will provide us the relief. So customs duty payable or not payable on this petty theft. Customs duty not payable by importer, but these imported goods which are unloaded will be under the custody of a custodian. So the custodian has to pay the customs duty. For example, you are importing 200 iPhones. In the 200 iPhones, 2 iPhones are missing. Now you have to pay customs duty only on 198 iPhones. On the 2 iPhones which is missing, the custodian has to pay the customs duty. That is this. And remarks, what custodian will do? He will restore the goods. So he will identify your stolen and he will restore those 2 iPhones. At that time, whether as the importer you are required to pay customs duty on those 2 iPhones, yes. If goods are restored, customs duty is payable by the importer. Whether it is applicable in case of warehoused goods, no. Means at what stage the pilferage should have happened? Before order for clearance. Before order for clearance means before filing bill of entry or before filing bill of entry for warehousing, before order for clearance, that time it should have happened. The moment you file bill of entry, they will pass the order for clearance. So therefore, before filing, like before passing order for clearance, this should have happened. Then section 23 subsection 2, that's the reason why section 13 is not applicable in case of warehoused goods. Section 23 subsection 2, relinquishment of title to the goods. This relinquishment of title to the goods, so wherein if you are importing the goods and that goods are not conforming to the specifications, then in that case the benefit will be customs duty not payable, and relinquishment not possible in case of prohibited goods, that is with respect to this. So relinquishment of title to the goods, goods are not conforming to the specifications, then you can relinquish the title. When you relinquish the title means leave the title, you are not required to pay. But if you are importing cocaine, weed, meth, etc., at that time you cannot say I will relinquish the title, sir, when you are caught. So prohibited goods relinquishment is not possible. And whether it is applicable in case of warehoused goods, no, relinquishment of title is not possible under this section with respect to warehoused goods, because for warehoused goods we have a different relinquishment of title, that is relinquishment is possible under proviso to section 68. Like this, we have in 3 places relinquishment of title. That 3 places is first before order for clearance. So you can see this information in page number, you can see this information in page number 283. Page number 283, goods are defective or not according to the specifications. So whenever you have imported the goods and the imported goods are defectives or not conforming to the specifications, as soon as the goods are unloaded and before order for clearance, as soon as the goods are unloaded and before order for clearance, if you come to know that the goods are defective or not conforming to specification, you can relinquish the title under 23 subsection 2. Are you required to pay duty? No, you are not required to pay the customs duty, but this is not applicable in case of prohibited goods or improper imports. Whereas after order for clearance but before actual clearance means the goods are deposited in warehouse, and at that point of time you have opened the goods and you came to know that the goods are not according to the specification or defective, still you can relinquish the title under proviso to section 68 with respect to warehouse goods. Are you required to pay customs duty? No, no need to pay customs duty, but this relinquishment is not applicable in case of prohibited goods or improper imports. After the goods are cleared from the warehouse or cleared for home consumption, within 30 days plus 3 months, you came to know that the goods are defective or not conforming to the specification, still you can relinquish the title, but here already you paid the duty because you cleared it for home consumption, so you will get the refund. Instead of no need to pay duty, it will be refund, 100% of refund of customs duty. This is relinquishment of title under section 26A, but this is not applicable in case of prohibited goods, not applicable for improper imports or perishable goods or used goods. You should not have used those goods. Even for perishable goods, this is not applicable. So these are the 3 places where we come across the relinquishment. So whenever you get a relinquishment question, related question, you connect this chart because anywhere it will be appearing. Okay. So then in case of 23 subsection 2 alone, relinquishment is not possible with respect to warehoused goods because we have a separate section in this regard. Okay, that is the connection to it. Then look into section 23 subsection 1, remission of duty. Remission of duty, it is like whenever the imported goods are lost or destroyed or abandoned, that is missing completely, and you don't know where the goods went. In that case, you pay the customs duty, prove to the satisfaction of the officer that the goods are destroyed, and you will get the refund. And we don't have any remarks. And whether it is applicable in case of warehouse goods, yes. Even if the goods are destroyed in warehouse, still we will get the benefit of relinquishment, remission of duty under 23 subsection 1. Then abatement. Abatement under section 22. Abatement is applicable in case of damage or deterioration to the goods, which means that the goods are there, but only thing it is not functioning as desired, so it is damaged. Or deterioration means reduction in the quality of the goods, that is deterioration. Even evaporation will come under deterioration of goods. Whether we need to pay customs duty? Yes, but we need to pay customs duty based on the damaged or deteriorated value, proportionate to that. If the value of the goods is 1,50,000, for 1,50,000 we need to pay customs duty 48,000. Now the value of the damaged goods is 1 lakh. Then proportionately we need to pay the customs duty, that is 1 lakh is the value of damaged goods, that is after damage what is the value, into 48,000 divided by 1,50,000 will get the proportionate customs duty payable. So actual customs duty minus this customs duty, that difference will be taken as the abatement. So Therefore, customs duty payable equals to value after damage into original customs duty divided by value before damage. That should be taken. And how to determine the value of damaged goods? Value ascertained by the officer, or gross sale proceeds in case of sale by public auction or tender or any other manner, so through which they will determine the value of those damaged goods. And whether it is applicable for warehouse goods. In case of damage, yes, it is applicable for warehouse goods, but in case of deterioration, it is not applicable, because the deterioration should have happened only before at the time of unloading. If it is after the deterioration happens, there is no benefit under this section. But in warehouse goods, if there is any deterioration, we have one section called as allowance for volatile goods. For example, you imported whiskey, and as per the bill of entry, the whiskey in each barrel is 1000 liters. But at the time of unloading, the whiskey is only 980 liters. Whether 20 liters anyone has put straw and consumed? No. It is evaporation that got evaporated. Now whether we get the benefit under section 22? Yes, because the deterioration happened before at the time of unloading, and after you have unloaded 980 liters, so the 20 liters relief you got. Now you have taken it to the warehouse, and in the warehouse some evaporation has happened. So now it is only 970 liters. So the 10 liters is missing in warehouse. Now in that case, that is because of evaporation. In this case, whether we get any benefit under this section? No, this section is not applicable, because we have section 70 which talks about allowance in case of volatile goods. There we will get the relief, provided the government satisfied that we need to pay customs duty only on 970 liters. The 10 liters we are not required to pay customs duty. That is this. So damage, yes, applicable for warehoused goods, and deterioration, no, only before unloading of goods it is possible. That is with respect to this. Next, so when this should have happened? When this should have happened, in the previous page you see that chart when this should have happened. Suppose if the goods are lost, that is goods are destroyed or goods are stolen, or it is lost before unloading. First of all, there is no levy. As per Mangalore refinery's case, there is no levy, consequently customs duty is not payable. Suppose if the goods are unloaded in the port or airport and before order for clearance, what are the sections you will get? All the sections. So goods unloaded in the port and before order for clearance, all the 4 sections are applicable. If the goods are pilfered, you can claim section 13. If the owner does not want to take delivery, relinquishment, even remission of duty under 23 subsection 1 abatement is also available at this stage. The moment order for clearance is passed, thereafter before actual clearance, only 2 sections. What are the 2 sections? Remission of duty if the goods are lost or destroyed, and abatement in case if the goods are damaged or deteriorated. Okay, so before order for clearance, all the 4 sections. After order for clearance and before actual clearance, there will be only 2 sections. After actual clearance, none of these 4 sections will be applicable. We might have some other sections that will be applicable in that case. Then you look into this. If the ship is, if the goods are lost in the ship before unloading, so then first of all there is no levy. That's what Mangalore refinery case says. There is no levy, so customs duty not payable. So there is no question of abatement or remission of duty, etc. So levy itself is not there. The person is not required to file any bill of entry. So consequently customs duty is not at all payable in that case. When? If the goods are lost. Suppose before unloading, if the goods are damaged, but the damaged goods are unloaded. In case of loss, the goods cannot be unloaded, but in case of damage, the damaged goods also can be unloaded, which means there is levy. So as there is a levy, so the abatement is applicable even before unloading if the damage has happened. But if any other loss happened before unloading, no other section. But in case damage happened before unloading, so definitely we will get the abatement. So section 22 will be applicable. During unloading, if there is any loss or damage, thereafter both the sections will be applicable. So 22 for abatement, 23 for remission of duty. Even during transit to warehouse, if there is any loss or damage, both the sections, any of these 2 sections. And suppose in the warehouse if there is any loss or damage, so both the sections, that is 22 or 23. So 22 when in case of damage, 23 when in case of loss or destruction. Then next page you see there is derelict, jetsam, flotsam, wreck, etc. Any goods which are derelict, that is which got derailed in the water, and jetsam which are thrown into the water to save it from sinking, that is ship from sinking. Flotsam, those goods which are thrown into the water will continue to float, and wreck, that is damaged parts of the ship. If it is brought to India by any person, as if it is import into India, they need to pay customs duty unless those goods are exempted from payment of customs duty. That is section 21. Then concession with respect to re-importation of goods as per section 20. So every time when you are importing, you need to pay the customs duty. We don't have any relaxation normally, but if you are covered under these two notifications, notification 45/2017 and notification 60 of 2018, then you have certain concessions. What is that? First, notification 45/2017, you remember UA. First you are importing, then you are exporting, then again you are doing re-import. Okay, UA you remember, UA. For first import, are you required to pay customs duty? Yes. And you export it. At the time of export, are you claiming any incentive? Yes. On re-import, just pay back that incentive, that is sufficient. You are not required to pay customs duty on re-import. So any incentive claimed on export, upon re-import, just pay that incentive. First you are importing a car, you paid the customs duty, and you are exporting the car for repairs. Then you did not claim any incentive because those car is exported for repairs. You did not claim incentive. The same car after repairs it is re-imported. Now what you need to do, if the goods are exported for repairs or any process and upon re-import, we need to pay fair value of repairs carried out outside India. Fair value means not the money that we actually pay, whatever is a fair value of that, material, labor, etc. plus freight and insurance both ways, onward and return, that should be taken. If export for repairs, upon re-import, customs duty is fair value of repairs including material and labor plus freight and insurance both ways, that should be paid as customs duty. One more situation, you imported, paid customs duty, you exported, neither you claimed incentive nor it is exported for repairs. Now normally it is exported, you did not claim any incentive. At the time of re-import, are you required to pay any duty? No, because at the time of export you neither claimed incentive nor you are exporting it for repairs. So upon re-import you are not required to pay any customs duty. Is it clear? And what is the time limit? From export to re-import, export to re-import, the time limit is 5 years plus 2 years. Okay, and in your old book you might be having 3 years plus 2 years, so you please rectify it. It will be 5 years plus 2 years. And in case of Bhutan, not Nepal, only Bhutan, it will be 7 years plus 3 years. 7 years plus 3 years. In case of foreign trade policy, it will be 1 year plus 1 year. This time limit is for what? Export to re-import. Export to re-import, the time limit 5 years plus 2 years, and Bhutan 7 years plus 3 years, FTP 1 year plus 1 year, that is it can be extended for a further period of 1 year. And one more condition is that it should be same goods and no change in ownership. What if the time limit goes beyond this? Then on re-import you need to pay normal customs duty. Actually here we have got a concession that on re-import we are not paying the normal customs duty. Suppose if you fail to fulfill these conditions, you need to pay the normal customs duty on re-import. Like even though import you have paid customs duty, again on re-import you have to pay separately some customs duty by treating it as fresh import into India. Then even IGST payable on fair cost of repairs including material, labor, freight, insurance both ways. If export is subject to export duty, then upon re-importation, refund of customs duty we can claim in terms of section 26. There is one section 26 for refund. Whenever you are exporting, you pay the customs duty, the same goods are returned back. Then why you need to pay the customs duty? So whatever customs duty you paid, you will get it as a refund, just like credit note, sales made, paid GST, you are getting it as return, means your liability should come down. Same logic, you are exporting, paying customs duty, the same goods are returned, so therefore whatever customs duty you paid on export, you will get it as a refund. That is section 26. If goods are exported under duty exemption scheme, advance authorization, DFIA, EPCG, then upon re-import, IGST and compensation cess if applicable payable, and the time limit for re-import is what? 1 year plus 1 year, that's what I have given here. For FTP the time limit is 1 year, which can be extended for a further period of 1 year. If goods exported are not subject to any incentive, this point also I told you, not subject to any incentive or exemption and not exported for repairs, then upon re-import customs duty is not payable. Then exported and imported goods must be same and the ownership should not have changed, and this particular notification is not applicable in case of 100% EOU, because original import itself 100% EOU, no need to pay customs duty. Unit in a free trade zone, no need to pay customs duty. Normal import itself. Public or private warehouse, no need to pay customs duty. Normal import itself, because when it is imported and kept there, we don't have paid any customs duty. Tobacco and petroleum products. So these are the cases where the concession under this notification is not applicable. Then there is one point which is connected from GST to here, that is if the goods are taken outside India for exhibition to display it over there, within 6 months the goods should be brought back to India. If it is brought back within 6 months, then upon re-import, whatever goods you have exported, Are you required to pay any customs duty? No. In case goods taken outside India for exhibition, upon bringing it back within 6 months from the date of export, customs duty is not payable. That is this point. What if it is not brought back within 6 months? On expiry of 6 months, it is deemed to have been sold. It is deemed to have been sold, and we need to raise the invoice, and that related procedure we have in GST. So it is deemed to be sold, sale on approval or return basis. Again, when it is brought back, whether you need to pay the customs duty, no, because we have the concession here. Why we have the concession here? At the time of export, did you claim any incentive? No. And whether you got any, like it is exported for repairs? No. So upon re-import, no need to pay customs duty. For customs duty, you need to refer these provisions only. Then notification 60 of 2018. For 60 of 2018, it is AU. First you are exporting, then importing and re-exporting. So first notification 45 2017 is UA. This is AU. First you are making export, then it is imported, then it is re-exported. So export to import, there is a time limit, and on this import no need to pay custom duty. That is a relief. You are exporting the same goods you are importing. On this import there is no need to pay customs duty. What is the time limit? If it is reprocessing, refining, remaking, within 1 year. If it is repair or reconditioning, notified goods within 7 years, other than notified goods 3 years, and in all cases 10 years in case of Nepal and Bhutan. And what are those notified goods? Certain machineries, computers, color TV, etc. These are the notified goods. So exported goods imported should be within this time limit. And after you have imported, you need to do the process and you need to re-export. What is the time limit within which you need to re-export? 6 months, plus it can be extended for a further period of 6 months. And condition, imported goods and re-exported goods should be same, and importer at the time of importation executes a bond. And if these conditions are satisfied, on import no need to pay customs duty. Between export to import, if there is any process loss, you have exported some quantity and you imported. If there is any process loss, in this case, are you getting the relief? Yes. Again, from import to re-export also, if there is any process loss, it is fine. If any loss of imported goods is noticed during such operation, such loss shall be exempted from whole of the customs duty subject to the satisfaction of ACDC of customs. The exemption is available even if the quantity re-imported is short or low in quantity. And customs duty not payable on import provided goods are re-exported within the stipulated time as above and conditions are fulfilled. That is the benefit. Then section 24, denaturing and mutilation of goods. So whenever certain imported goods has higher rate of customs duty, and depending upon the usage, the customs duty is payable, then you make it unfit for the other purpose. So accordingly, the customs duty will be payable. That is known as denaturing. Mutilation of goods, that is you don't need all the goods, you need only the parts of the goods. Then in that case, you take the parts out and mutilate that goods, remaining goods, so that you pay customs duty only on the parts that is imported. Owner of the goods will make request for denaturing. Example, diluting the chemicals, and so that it will be made unfit for other purpose. And mutilation, example, breaking the machinery. And central government may make rules in this regard, and duty is payable as if goods are imported in denatured or mutilated form. Then section 25A and 25B, two sections are there, but these two sections are not yet notified. This is there in the study material, but they have not yet notified these sections. So due to that reason, it may not be tested in exam. So you remember what is this about? That is, you are importing goods for processing, or you are exporting the goods for processing there. When you are importing the goods for processing, you have to send it back within 1 year. And if you are exporting the goods for processing, you have to bring it back within 1 year. That is the condition. And same goods should be brought and applicable in case of notified goods. Okay. But still they have not yet notified. So what is that you need to remember here is only the time limit. What is the time limit? 1 year. So if you are doing this on import, no need to pay customs duty. Whenever you are importing, you are not required to pay customs duty on that. That is this 25A and 25B. The next area, classification of goods and types of customs duty. So one student is asking, please upload the timestamps. I will do that. I am taking class. Okay. You help me, no? You are listening. So you can help me the timestamps and all. So you comment it, I will put it in the pinned message. Okay. So I have to search and I need to put the timestamp. If possible you do, I will do it. After completion of this batch, I will do. Then I don't have people, pa. Everything I only should do, pa. Okay. But other things I can delegate it. These things and all I only should do. So say this, general interpretative rules, and one student is asking, sir, whatever extra information and all you are telling, that alone you take separately and give it as a PDF. What you will do here? What effort you do here? You put some effort here. Little bit you also do here. Everything you don't depend on me only here. Little bit you do. Whatever extra I am writing, whatever extra I am telling. So why should I type all those things and give? Why should I do? You know, beyond a point, I am losing my patience here. So why should I do? I am teaching it. You do no, you write no, you know how to write. You have a pen, you have a paper, you write no. At least that much you write. That also you are depending. Previously and all, teacher used to tell how to eat banana. Now we are making it into juice and we are putting it in your mouth directly. As to banana juice we are doing. Digestion you should do, sir. That also I cannot do, sir. And I cannot wash the next day, sir. You understood? So that and all you only should do. Minimum that alone you do, sir. So general interpretative rules are rules for interpretation of tariff. So that is for the purpose of classification of goods. Classification here refers to the imported goods needs to be classified under the respective heading, that is known as classification, because in customs tariff there are different headings and the imported goods may fall under any of the headings. So whenever we get a confusion with respect to classification, these general interpretative rules will be helpful for classification. Rule 1 says that the titles are for reference only. So don't classify based on just the titles. You read the section notes and chapter notes. In that section notes or chapter notes, they will give some information as to this product will be falling under this heading like that. So based on that we need to classify. So rule 1, the titles of sections, chapters and subchapters are provided for reference only. Classification will be based on headings read with relevant section and chapter notes. Rule 2a, any reference to complete goods also includes incomplete or unfinished goods. That is, completed goods includes incomplete or unfinished goods which is having the essential character of finished goods. Example, you are importing a car. That car without seats and without tires, still it will be classified as car only. Even though it is incomplete, you need to classify it along with the completed product. 2b, any reference to a material includes combination of that material with other material. You are importing gold jewelry which is made up of gold and copper. Then in that case it will be classified as gold only. Even though it is not 100% gold, it may contain copper, still it will be classified as gold. That is, material equals to combination of that material with other. Rule 3a, specific description shall be preferred to general description. You are importing electric shaver. That electric shaver has a general heading, electromechanical domestic appliance. Another specific heading, shavers and hair clippers. As shavers and hair clippers is a specific heading for electric shaving machine, so it should be classified there. So prefer specific over general. Rule 3b, classification shall be as per essential character. If a particular product is mixture or composite of goods containing different materials, for example, you are importing a geometry box. The geometry box has lot of articles, drawing instruments like that one heading is there, pencil one heading, eraser one heading, sharpener one heading, and the metal case is one heading. Now what you need to do, what is the essential character in this? Drawing instruments. So all other products also should be classified as drawing instruments only. That is this classification as per essential character. If both the headings are specific, the latter the better. You are importing a vehicle that can be used for both transportation of goods as well as transportation of passengers. There are two headings, both are possible because this vehicle is common for transportation of goods and passengers. We need to see the latter the better. So which comes last in the numerical order, that should be taken. Akin goods. Akin goods refers to similar goods. When you are importing the goods, you could not find it anywhere in the tariff. Then see what is a similar goods. Example, you are importing this microfilm, sun protector films to put it on the glass. Then in this case, that is car window. Then that should be classified along with the curtains and blinds which is used in the building to prevent the sun glare. It should be classified there. That is this akin goods. And packing materials, if it is a specific packing material, it should be classified along with the main article. For example, you are importing a violin box. That violin box can be used only to keep violin. So violin box should be classified at the rate applicable to violin. If it is a general packing material which can be used for packing anything, for example general plastic boxes, tins, etc., then we should see whether we have a separate heading for that and it should be classified there. And goods can be compared for classification at the same level only, which means a particular heading under one particular chapter should not be compared with any other heading and all. So within that chapter or within that heading only we need to do the classification comparison. Goods can be compared for classification at same level only, that at headings or at subheadings, but one heading with a chapter cannot be compared. Okay. Then normal customs duties, we have some customs duty computation. So we have steps involved. What are the various customs duties? We have basic customs duty. Basic customs duty will be either preferential rate or the standard rate. If in the question they give both the rates, standard rate and preferential rate, first check whether they are eligible for the preferential rate. When they are eligible for preferential rate, if they are importing goods from a country with which they have preferential trade agreement, then the preferential rate will be applicable. If no information related to that is given in the question, you take the standard rate only and applicable rate that will be given in the question, and it should be computed on assessable value. And social welfare surcharge, whether it is given in the question or not, always we need to compute it at the rate of 10% on assessable value. And integrated tax, that is IGST under section 3(7). While computing IGST, remember we need to add all customs duties including anti-dumping duty, safeguard duty and anti-subsidy duty. Everything we need to add, and finally we need to compute IGST. So IGST is at the rate of force which is given in the question on assessable value plus all customs duties. Same way compensation says, if compensation is given in the question, you need to do it in the same way like IGST. You take assessable value plus all customs duties, but don't add IGST while doing compensation says. So a compensation says as well as IGST will be computed on the same value. So GST compensations is in force on assessable value plus all customs duties. And in the past on imports there used to be countervailing duty under 3(1), and which was levied in order to counterbalance excise duty, and special additional duty under 3(5), which was levied in order to counterbalance sales tax. But now also it is there, limited only to few goods. What are the goods for which CVD and SAD is applicable? CVD is applicable to counterbalance excise duty right now in case of 3 goods. What are they? Number 1, alcoholic liquor for human consumption, undenatured extra neutral alcohol, because that is outside the ambit of GST. So state excise duty will be applicable, and therefore CVD will be there on import. Is it clear? Don't forget, this is a connecting assumption, like connecting amendment. So on import of alcoholic liquor for human consumption, undenatured extra neutral alcohol, rectified spirit used in manufacture of alcohol, there will be CVD. Second, petroleum products, there will be CVD. Tobacco and tobacco products, there will be CVD. What are the goods on which SAD is applicable? Only one, that is petroleum products only SAD will be applicable. So in case of exports, only basic customs duty is applicable if exports are chargeable to duty. Not all exports are subject to duty. Only if it is subject to duty we need to pay. Majority of the exports are exempted. Only few exports are subject to duty. And in that case only basic customs duty. Don't take social welfare surcharge. Keep that in mind. Only in case of import, social welfare surcharge should be taken. In case of warehoused goods sold by way of transfer of warehouse receipt, IGST under customs shall be computed on assessable value, basic customs duty plus social welfare surcharge, or the sale value of such warehouse receipt, whichever is higher. For example, I am importing the goods for $10,000, keep it in the warehouse, and thereafter I transfer the warehouse receipt to you for $11,000. What should be taken as the value for computing IGST in your hands, because you are only going to clear the goods? First you need to take assessable value $10,000 plus basic customs duty plus social welfare surcharge plus all other customs duties. This is A. B will be $11,000 because that is the price at which you are purchasing. Whichever is higher into customs duty payable, that should be like into IGST rate should be taken as the IGST payable. That is in case of warehoused goods sold by way of transfer of warehouse receipt, IGST under customs shall be computed on A. A will be assessable value, basic customs duty, social welfare surcharge, or B, sale value of such warehouse receipt, whichever is higher. And next one more point, when basic customs duty is nil, social welfare surcharge also nil as per CBSE circular, and we have a preferential rate under section 2, or those imports which are made from country in which India is having trade agreement. For computation of IGST and GST compensation says whether we need to include additional customs duties also, yes, that is safeguard duty, anti-subsidy duty and anti-dumping duty shall be included. So this is an important area, and somehow my intuition says that this can be tested for this attempt, because from quite a long time they did not ask about computation of customs duty. So they will be testing this. That is, I have imported the goods and I transfer the document of title when the goods are in transit. How to compute the customs duty in this case? I am the importer, you are my buyer, and I have transported the, like I have been importing the goods. When the goods were in transit, I imported at $10,000. I sold it to you for $12,000. Now what is the treatment in this case? What should be taken as assessable value in your case? You are the importer. What should be the assessable value? $12,000. The price at which you are purchasing from me should be taken as the assessable value in case of high seas. During transit, in case of high seas, what will be the assessable value? Last purchase price should be taken. Okay, I am importing for $10,000. I sold to you for $9,000. What should be taken as the assessable value? $9,000 only, not whichever is higher. The price at which you are purchasing from me. So whether I am importing at 10,000 or not, irrelevant. At what price I am selling to is only relevant. So the last purchase price will be taken as the assessable value. Now you need to start from there. Basic customs duty, social welfare surcharge, and IGST you compute normally. Don't compare. Don't compare, because already you are taking the last purchase price. Don't compare. Normally you take the IGST, that is assessable value plus basic customs duty plus social welfare surcharge, and on that IGST needs to be taken. So therefore computation of IGST regular, assessable value plus basic customs duty, social welfare surcharge. Is that clear? Second, suppose if it is sale of warehoused goods, I am importing for $10,000 and I sold it to you for $11,000. What should be taken as the value? I am importing for $10,000, I sold to you for $11,000. What should be taken as the assessable value? $10,000 only. So assessable value will be original import price. Only for IGST you need to do the comparison now. What is the comparison? A, assessable value, basic customs duty, social welfare surcharge, or B, GST on sale value. That means that IGST on the transaction value of such sale of warehouse receipt, whichever is higher should be taken. Suppose if it is normal goods which I am importing and I am making sale to you, then what should be taken in that case? Normal goods which I am importing and making sale to you, then whatever is the price at which I have imported, that is assessable value, original import price, and I will only pay IGST, that is normally I will compute assessable value plus basic customs duty and social welfare surcharge. Is that clear? Then emergency power of central government, section 8 and 80 of Customs Tariff Act. So if the goods are covered under the import schedule, means already covered under the first schedule, that is import tariff, then we cannot bring anything into the import tariff just like that, but already if it is there, that can only be increased. Whether central government is having power to emergency power without touching the Parliament and Finance Act, can they increase the rate of customs duty? Yes. But can they bring a product into the levy of import duty? No. Whereas in case of export, can they bring a product into the levy of export duty using emergency powers? Yes. And can they increase the rate of customs duty on export? Yes. See that. First schedule, import tariff, they can only increase the customs duty. Whereas second schedule, export tariff, can impose the customs duty or can increase the customs duty by notification official gazette if the circumstances exist. Then these are the additional customs duties. We'll take a small break and then continue with this. Okay. We'll meet after 10 minutes. Okay, we'll continue. Look into this additional customs duties on import. The first one is safeguard duty. Safeguard duty is applicable whenever the goods are being imported in large quantities. It is not on account of the mistake of the exporter, therefore it will be fair export only. And safeguard duty is levied under section 8B of Customs Tariff Act 1975. And the authority levy, it is levied by central government either based on receipt of complaint or information. And basically it provides serious injury to domestic industry on account of imports in large quantities. So the domestic industry is getting injured on account of large imports. To protect the domestic industry, they will levy safeguard duty, and the extent of relief will be to extent adequate to prevent the remedy, which means that the safeguard duty is levied in order to increase the price of the imported goods in such a way that it will be on par with the locally manufactured goods. So the rate will be given in the question. So you need to take it on that, and usually that percentage will be either on assessable value or on landed value. But suppose if the question is silent, you compute it only on the assessable value. What is landed value? Landed value will be assessable value plus basic customs duty plus social welfare surcharge. So therefore either it will be on assessable value or landed value. If the question is silent, take it on landed value or assessable value. And next, investigation is required. Provisional duty, yes, until completion of the investigation they can levy a provisional duty, and duration of provisional levy will be 200 days, means within 200 days they need to complete the investigation and they need to fix the levy. So then up to the 200 days they can levy provisional duty. What will happen upon finalization? Suppose if there is no levy of safeguard duty, whatever we already paid needs to be refunded. Suppose if excess paid also will be refunded. If there is any shortfall, we need to pay either refund allowed or differential duty payable on account of finalization. Duration of levy, it will be levied for a period of 4 years, and it can be extended for a further period not exceeding 6 years. In overall, the maximum will be 10 years. And previously we had protective duty under section 6. That is now omitted, we don't have. Then safeguard duty is exempted in some cases when if it is imported by 100% EOE or SEZ, no need to pay safeguard duty. However, it is imported by EOE or SEZ, then cleared to DTA, then safeguard duty will be applicable. However, it should not be cleared to DTA from there. Then articles originating from developing country, a developing country, that is from a single developing country we are importing, and percentage of import from that developing country does not exceed 3% of the total imports of that article into India. We are not importing from many developing countries, only one developing country, rest and all we imported from developed countries. Import from that developing country does not exceed 3%, that is less than or equals to 3% of the total import of that article into India. So imports of that article into India is less than or equals to 3% of the total imports of that article into India. Articles originating from more than one state, more than one developing country. So therefore this third point is applicable when you are importing from more than one developing country, and from each developing country with less than 3% share together does not exceed 9%. So therefore we need to group all the developing countries with less than 3% and take it together. It does not exceed 9%. So then from that group there is no safeguard duty. For example, 4 countries A, B, C, D, developing countries, A, B, C, 2%, 2.5%, 2.8% and 3.6%. This 3.6% don't take. These 3 countries you see, together it does not exceed 9%. So therefore for import from these 3 countries, there won't be safeguard duty. However, the 3.6% is there na, on that country there will be safeguard duty. What about developed countries? Definitely there will be safeguard duty. And import from specified countries, there can be relaxation. So these are the 4 cases where safeguard duty is not applicable. Mark it as important for theory, and retrospective levy not applicable in this case. Next one, second, we have anti-subsidy duty. Whenever goods are being imported where the exporting country has given the subsidy, it is an unfair export by the exporting country. It is levied under section 9 of Customs Tariff Act. Again, it is levied by central government upon receipt of complaint or information. Relieve serious injury to domestic industry on account of subsidy enjoyed in export pricing. As the exporting country gave a subsidy, the product is being imported into India at a cheaper rate, because of which the domestic industry is getting affected, and the extent of relief to the full extent of subsidy allowed in export price. Again, here also it will be a percentage. That percentage will be either on assessable value or landed value. If the question is silent, you take it on assessable value. Investigation required. Till that time they can levy provisional duty. The investigation should be completed in 4 months, and thereafter either we will pay or we will get the refund upon finalization. Duration of levy, here there is no time limit, maximum time limit unlimited time, but initially it should be levied for a period of 5 years. For every 5 years they need to take a review, and still the domestic industry is affected, they can extend it for a further period not exceeding 5 years. So that is at a time after review, and maximum will be unlimited time. And when anti-subsidy duty is not applicable, anti-subsidy duty as well as anti-dumping duty both are not applicable if the goods are imported by 100% TOU or SEZ. However, it should not be cleared from there to DTA, and if such articles are exempted in the exporting country, it is not treated as subsidy. Naturally, it is exempted goods in that country. And if imports from member country of WTO or imports from specified countries, so then these two will not be applicable, that is the exemption. Then look into anti-dumping duty. Anti-dumping duty, when goods are being imported at a price less than their domestic selling price, then there will be anti-dumping duty. Is it fair export made or unfair export? Unfair export made by the exporter. Section reference section 9A. Authority to levy, levied by central government upon receipt of complaint or information. Relief against serious injury to domestic industry on account of import of goods at a cheaper price. That is what they are selling in their country at $100, but they are exporting to India at $75. Means they are selling to India at a price less than their selling price, means they are dumping it to India. So now we need to take extent of relief. Anti-dumping duty is not percentage, it will be absolute. So we need to determine the amount. That will be dumping margin or injury margin, whichever is lower. What is dumping margin? The price at which they are dumping to India, that is export price, minus the local selling price there. So the local selling price in our example is 100. What is the price at which they are selling to India? That is 75. So the difference will be taken as the dumping margin. So normal selling price in exporter country minus the price at which it is exported to India, that is dumping margin. Injury margin, that product which is dumped from there will be imported into India, and in India we should see what is the normal selling price in India minus what is the landed value of the goods. Say the normal selling price in India is somewhere like $120, but the landed value is $100, then the 20 will be taken. So 25 or 20, whichever is lower, will be taken as the anti-dumping duty. So injury margin will be normal sale price in India minus landed value. What should be taken as the landed value? Assessable value plus basic customs duty plus social fair surcharge should be taken. And here also investigation required, provisional duty until investigation is completed. Duration of provisional levy, that will be 6 months. Excess duty on account of finalization, not, either it will be refund allowed or differential duty payable. And duration of duty, same like anti-subsidy duty, 5 years plus 5 years at a time after review, and maximum unlimited time. And these two cases, the exemptions are common. And here if you observe, there is that review. What if review is not conducted within 5 years? There is an automatic extension for a period of 1 year if the review is not done within a period of 5 years. So therefore 5 years review not done, 1 year it is extended. In that 1 year they need to decide whether to extend or not, otherwise the notification will be lapsed. There won't be anti-subsidy duty or anti-dumping duty on those articles. If they decide, it will be extended for a further period of 5 years. And in last two cases, safeguard duty, there is no retrospective levy, only prospective levy. But anti-subsidy duty and anti-dumping duty, there is a retrospective levy. Means today they can give a notification to levy on imports which is made within 90 days prior. So up to 90 days before the date of notification, they can do the retrospective levy. In case of imports in large quantities, government can also resort to tariff rate quota. Rather than fixing safeguard duty, they will tell this much quantity you can import at the regular rate. Beyond this, if you are importing only, you need to pay additional rate, like that. They can fix tariff rate quota, fixing the maximum quantity of imports as a safeguard measure instead of safeguard duty. In that case, all the provisions of 8B will remain the same. Anti-subsidy duty and anti-dumping duty is mutually exclusive. So whenever there is anti-dumping duty, anti-subsidy duty is not applicable. And then anti-subsidy duty is there, anti-dumping duty is not applicable. And here, in case of anti-dumping duty, when you don't have the export price, that is dumping margin, sale price in the exporting country minus export price to India, when you don't have the export price to India, then what should be taken? So they will definitely have the export price to India. What they will not have is the sale price in exporting country, because export price is the price at which they are selling, otherwise how the anti-dumping duty can be determined. So what is not available to us is the sale price in their country. If that is not there, you take the price at which they are exporting to a third country. That third country export price will be taken as the normal selling price in that country. If that third country export price also not there, then we need to ascertain cost of production plus usual profit margin. Say this, in case of anti-dumping duty, if sale price in exporting country is not available, then export price to third country is considered. In the absence of export price to third country, cost of production to exporters and usual profit margin will be relevant. Cost of production to exporter and usual profit margin will be taken as their normal selling price. Then we have circumvention of anti-subsidy duty and anti-dumping duty. That is, in case when you try to escape from payment of anti-subsidy duty or anti-dumping duty by changing the name or description of the article, or by importing from a different country of origin, or by importing in unassembled or disassembled form, in that case, whatever is the existing notification for anti-dumping duty, anti-subsidy duty can be extended to these articles for which you change the description, for which you imported in unassembled form, or you are importing from a different country of origin. That is this circumvention of anti-subsidy duty and anti-dumping duty. Absorption of anti-subsidy duty and anti-dumping duty means whenever it so happens that the person tried to reduce the export price, that is the exporter tried to reduce the export price in order to give the relief to the importer to whatever here anti-subsidy duty and anti-dumping duty is levied. To that extent, exporter has reduced the price in order to make the importer enjoy the advantage of import pricing. Then government, without giving a new notification, the same notification, to what extent they reduce the export price, here government can increase the anti-dumping duty and anti-subsidy duty. No need to give new notification, no need to carry out fresh investigation. By default, to whatever extent exporter has reduced the export price, to that extent here the anti-dumping duty and anti-subsidy duty can be enhanced. So these two are theory questions. So this can be asked. Write a brief note on circumvention of anti-dumping duty or absorption of anti-subsidy duty to anti-dumping duty, like that. You need to write this information. Then against the order of anti-dumping duty or anti-subsidy duty, we can go for an appeal, and that appeal to be made within 90 days from the date of the order. If you are satisfied that the duty should not be levied, then you can go for an appeal. And these are the old customs duties which is relevant in the current scenario. We know that on alcoholic liquor for human consumption, rectified spirit, and denatured extra neutral alcohol. So what is leviable right now? On import we need to pay CVD, countervailing duty. Then on petroleum products we need to pay CVD and SAD. Is there SAD on alcoholic liquor? No. On alcoholic liquor we have only CVD. Only on petroleum products we have CVD and SAD. On tobacco and tobacco products we have CVD as well as IGST. On import, because we have both excise duty and GST on local sale. Then on all other goods we don't have CVD, SAD, only IGST is leviable. From this only I told you what are the goods on which CVD is applicable. Alcoholic liquor for human consumption, and this alcoholic liquor for human consumption includes undenatured extra neutral alcohol and rectified spirit. So these two are also included. So on import of which we need to pay CVD, petroleum products import we need to pay CVD, tobacco and tobacco products import we need to pay CVD. SAD is applicable only on one product, that is petroleum products only SAD is applicable. On all other goods we have IGST, that is applicable as applicable. What is the computation of customs duty? You have to remember this template. First we need to take the assessable value. Say the assessable value is 15 lakhs and the basic customs duty at 10%. That will be given in the question itself. You don't have to do anything with respect to that. It is on assessable value. So 15 lakhs into 10%, 15,000. Then social welfare surcharge. Social welfare surcharge will be always 10% of basic customs duty. So 15,000 into 10%, that will be 1,500. Then CVD will be at the rate of 12.5% on assessable value, basic customs duty and social welfare surcharge. But this will be applicable only to alcoholic liquor for human consumption, petroleum products, tobacco and tobacco products. Now if it is there in question only we need to take when we do the total of this. And remember CVD is computed on what? Assessable value, basic customs duty, social welfare surcharge. On that CVD will be computed. So customs duties as per block 1 will be 16,500. This is exclusive of additional customs duties. Then we have safeguard duty. Safeguard duty, again the rate will be given on what? Assessable value or landed value, and anti-subsidy duty at rate given on assessable value or landed value. Anti-dumping duty, lower of dumping margin or injury margin. Dumping margin, normal selling price in exporter country minus export price. Injury margin, selling price in India minus landed price. So these three if you have in the question, we need to take. if you add this, that is block 2 total, customs duty is excluding IGST and GST compensation cess. Then finally you need to take IGST. The rate will be given in the question itself, 12% on what? Assessable value plus step 2, like block 2 total. What is block 2 total? 16,500, that is 1,50,000 plus 16,500 on the 12%. So while computing IGST, we need to add everything, and on the top of that we need to multiply 12%, 19,980. GST compensation says, this GST compensation says at the given rate on what? Assessable value plus step 2 total. So we need to take, and SAD also same at the given rate on what? Assessable value plus step 2 total. So this third block always compute on assessable value plus step 2 total, but SAD is applicable only to petroleum products. Now when you add this 16,500 plus this, total customs duty payable. So these are the various customs duties that we have. Just remember this is the way in which you need to arrive. There is something called as Agriculture Infrastructure and Development Cess, AIDC, which is levied only on specified goods, that is apples, chenna, etc. at notified rate on assessable value, which is part of block 1, So here it will come, this AIDC will come here. So therefore it will be part of block 1. If it is given in the question only, we need to take, and that will be just taken here. It is computed always on assessable value. And while computing IGST, whether AIDC will be included? Yes, as it is coming in block 1. So when you take IGST, you are taking block 1, block 2, everything. So therefore definitely on AIDC also there will be IGST. And block 1 in computation of customs duty, for safeguard duty, compute on assessable value if the question is silent. Even for that anti-subsidy duty the same. So we need to take assessable value when the question is silent. Then next one, section 19 of Customs Act, not Customs Tariff Act. Section 19 deals with relevant date for determination of rate of duty in case of goods imported as set of articles. So whenever goods are imported as set of articles, as per section 19, we need to check whether the articles are liable to ad valorem or not liable to duty. If it is liable to ad valorem, that is percentage of value. So we are importing different articles, say 4 articles, which has different rates of customs duty, but it is imported as a package. Now in that case, whether we need to pay customs duty as a percentage of value, yes, that is ad valorem. Now you need to see whether it is the same rate or different rate. If it is same rate, no confusion. Take the entire value of the package into multiply with the same rate, that is a basic customs duty. Suppose if it is liable at different rates, then what we need to see the highest rate between this, and the highest rate will be taken. So by default it will be like mixed supply, highest rate will be taken. Suppose if the articles value is separately ascertainable, you treat it as individual supplies, which means that respective rate will be taken for respective value if the value is ascertainable separately. If the values are not ascertainable separately, as a package we are importing for a single price, so we need to take the highest rate. However, if it is a main article and the remaining articles are compulsory accessories, then we need to take the rate of main article. So if it is liable to duty at same rate, chargeable to duty at that rate, liable to duty at different rates, separate value can be ascertained, chargeable to customs duty accordingly based on separate value. If it is compulsorily supplied along with the main article and separate price not available, entire consignment chargeable to duty at the rate applicable to main article. If it is capable of supplying separately but separate price not available, entire consignment chargeable to duty at the highest of such rates. Even if there is any article not liable to duty, the same will be liable to duty like this. For example, out of the 4 products, one product is nil rate of customs duty. Even then, while taking the highest rate, so even this product value also will be subject to highest rate, that is this. Ad valorem means customs duty payable as a percentage of value. Specific duty means customs duty payable as a units of measurement. In case of specific duty, there is no problem, because anyhow you need to pay on absolute. For this product 200 rupees or 1000 rupees means that much only we will be paying as customs duty. Then valuation under customs, you see this. So there are different prices in the international context and international commerce. What are the different prices used? This known as Incoterms. So these are the various Incoterms. First we have ex-factory price. Ex-factory price means the price prevailing at the exporter's factory gate is known as ex-factory price, and free alongside price, that is the price prevailing at the port of the exporter before loading, is known as free alongside. What is the connection between X factory and free alongside? X factory plus transportation up to the port or airport is known as free alongside, and FOB price ready for shipment, the price prevailing at the port which is ready for shipment, which means that we need to add loading charges also. So X factory plus transportation up to port or airport will be free alongside plus loading charges will be taken as FOB price. FOB price plus freight and insurance up to India will be taken as CIF price, and that CIF price will be taken as value for payment of customs duty on import, and any post importation expenses are not part of value because we need to take the price prevailing at the time and place of importation. So these are the various prices. The equation is like this: X factory price plus transportation charges up to exporter's port or airport, FAS plus loading charges, FOB plus freight and insurance equals to CIF, cost, insurance, freight. And this is the template for determining the assessable value in case of import. First you need to take the X factory price, that is the price at exporter's factory, add freight from factory to load airport, you will get free alongside price, add loading charges in the load airport, you will get FOB price, that is the FOB price as per invoice. Sometimes directly in the question FOB price can be given, you start from here, or sometimes the X factory price is given, you start from there, or they can also give free alongside price also in the question, and FOB price as per invoice will not be taken as the base. We need to make primary adjustments. That primary adjustment when you are making, you will get the FOB price as per customs FOB price. These primary adjustments are given under Rule 10, Sub-Rule 1 of Customs Valuation Rules 2007. You need to remember this and you need to write that. Rule 10, Sub-Rule 1 of Customs Valuation Rules 2007. And these are the 5 primary adjustments to be made, and then we will get the FOB price as per customs, and to that FOB price as per customs we need to make the secondary adjustments. We have only 2 secondary adjustments, that is given under Rule 10 Sub-Rule 2, that is freight and insurance. Then you will get the CIF price which is taken as the assessable value under customs. Remember, after making primary adjustments only, you ascertain the FOB price as per customs, then only you need to add freight and insurance. Don't directly add the freight and insurance in the primary adjustments itself. So what are those 5 primary adjustments? Number 1, selling commission, container cost, packing cost. These 3 expenses will be incurred by the importer. Actually these 3 expenses are to be incurred by the exporter, but on behalf of the exporter, which is incurred by the importer, therefore it should be included in the value. So 3 expenses: selling commission, container cost, packing cost, incurred by importer. Number 2, direct material, consumables, molds and dyes or intangibles procured outside India. Total 4. Direct material, consumables means indirect material, molds and dyes or intangibles procured outside India. All these 4 are sent by the importer to the exporter, which is used in manufacture of finished goods, which are then imported, supplied by importer to exporter free of cost or at concessional rate. Then at the time of import, usually exporter will not charge anything for these things because we gave it freely. So we need to add it because we are ascertaining the value of the imported goods. So either actual cost you add or apportioned cost you need to add. Then number 3, royalty, license fee payable by the importer. So as a condition as per the contract. So whenever we are importing the goods, apart from the price of the goods, we also need to pay royalty or technical fees or license fee for those imported goods. So that should be added in the value. Then royalty, license fee or proceeds payable for resale or disposal or use of imported goods. That is, we are required to pay royalty not for the imported goods but for usage of that imported goods. If it is ascertainable at the time of import, that should also be included because all these are the amounts which we are paying to the exporter. Finally, all expenses incurred by exporter and charged to importer when before import, definitely it should be included in the value whether it is as a condition of sale or not. Suppose if it is after import if he is charging, that will also be included provided we need to pay as per the contract, for example installation charges or any other expenses which the importer is required to be payable to the exporter even though after import, but it is payable as per the contract of sale, that should be included in the value. So these 5 inclusions will come in the primary adjustments. Then we need to take FOB as per customs add secondary adjustments, you will get the CIF price. Then transaction value in case of import is the price prevailing at the time and place of importation. If there is a change in contract price, consider the revised price at which goods are imported. Even though the invoice price is different, but as on the date of importation, if there is a negotiated price, and that negotiated price is the price which is paid by the importer to exporter, so take that negotiated price only as the transaction value. And adjustments to FOB price, so first commission, I told you selling commission, so this 10.1 is connected to this. This is the super summary, and in that we are discussing, so selling commission only should be included. What about buying commission? It will not be included. Why buying commission not included, selling commission included? Buying commission is the commission paid by the importer to his agent. It is his expenses. That will not be consideration to the exporter. So it will not be included in the value. So buying commission, commission to importer's agent paid by the importer, that will not be included in value. Whereas selling commission is a commission paid to the exporter's agent. Who is paying that commission? If the exporter is only paying, why it will be included in value? It will not be included in value. For exporter's agent, if importer is paying, definitely that should be included in value because it is an indirect consideration to the exporter. So selling commission, commission to exporter's agent. Who paid it? Paid by exporter, not included in value, but paid by importer, it's an indirect consideration to the exporter. So therefore that should be included in the value. So when selling commission will be included in the value? Selling commission paid by importer to be included in the value. Then the other name for selling commission is local agent's commission, because the exporter's agent will be in India and the importer's agent will be outside India. So therefore the other name for selling commission is local agent's commission. Then second one, that is this material point, material consumables, that point. So material which is sent by the importer to exporter, including capital goods and intangibles. But remember where the intangible should be procured. The intangible should be procured outside India. The intangible should be procured outside India. If the intangibles are procured in India, that will not be included in the value. The intangible should be procured outside India. That already I gave here. The intangibles are procured outside India. Then to be included in the value. How it will be included in the value? Either at actual cost or at the apportioned cost. And it is used in manufacture of imported goods. Then all other expenses recovered by exporter before import, definitely to be included in value. After import as a condition of sale as per contract, to be included as per importer's request, that will not be included because post import expenses will be included only if it is paid by the importer to exporter as a condition as per the contract. Then so this is secondary adjustments. Secondary adjustments we need to make only freight and insurance as per rule 10 sub rule 2. So FOB price we will take, add insurance, add freight. And what is a FOB price? FOB price given plus primary adjustments, that is the revised FOB price. FOB price given plus adjustments as given above is the revised FOB. To this revised FOB we need to add insurance, we need to add freight. Insurance ascertainable, take actuals. Not ascertainable, take 1.125% of FOB. And freight ascertainable or not ascertainable? Not ascertainable, 20% of FOB should be taken. If it is ascertainable, if it is air freight, you take actuals or 20% of FOB, whichever is lower. Other freight, you take actuals. So even though actual air freight is ascertainable, we need to compare it with 20% of FOB. Which FOB? Revised FOB. And then we need to take whichever is lower. Even 1.125% should be computed on what? Revised FOB only. And when it is not at all ascertainable, we need to take 20% of FOB. When the question is silent about the freight and insurance, should we take it or not? Yes, definitely we need to take, even though in the question whether it is given as ascertainable or not ascertainable. So if it is freight not given in the question, we need to take freight at 20% of FOB. If suppose insurance is not given in the question, we need to take 1.125% of FOB. Is it clear? So they may specifically mention insurance not ascertainable or freight not ascertainable. Like that the wording may be given or may not be given. Okay. And in one question in solved workbook, so many students got the doubt with respect to that. That is, they have given barge charges. That barge charges itself is the freight. That barge charges itself is the freight. That's the reason why we have not taken 20% of FOB. If nothing is given, then we will take 20% of FOB as the freight. But they have given barge charges. What is this barge charges? To bring the goods up to place of importation is the barge charges. That is nothing but a freight which is given. So therefore, we don't have to take 20% of FOB in that case. Then this freight shall include handling charges not at the place of import, and ship demurrage charges. Handling charges means during transit, if there is any handling charges, that will be part and parcel of freight. And ship demurrage charges which is payable by the person in charge of the conveyance for anchoring the ship at outer space, that ship demurrage charges is also part and parcel of the freight. And lighterage and barge charges is to bring the goods from the ship to the shore, that will also part and parcel of freight, that is charges incurred for transportation of goods from ship to shore. Very, very important point, ship demurrage charges will be included in the value because it is during transit, but there is normal demurrage charges which is payable or paid by the importer after import for not clearing the goods within the time, that will not be included in the value because it is post importation. But ship demurrage charges is before importation, so that will be included, but normal demurrage charges not included in the value. In this regard, there is one very, very important point, so that may be tested. I think already it is tested in the exam also. That is, whenever we have ex factory price, what is the treatment to be taken? Say ex factory price is given and that ex factory price is somewhere like $10,000, and we have freight up to exporter's port, and loading charges, that is also definitely in exporter's port only. The freight up to exporter's port is 1,500 and the loading charges is $500. Then we need to take, thereafter FOB price. What is the FOB price? The FOB price will be $12,000. The FOB price will be $12,000, and we need to make some primary adjustments. Suppose if we don't have any primary adjustments and we need to check freight. What is that freight? Not ascertainable. Freight is not ascertainable. Then how much should be taken as the freight? At 20% of FOB. What is the 20% of FOB? So we need to take 12,000 into 20%. That is $12,000 into 20% equals to $2,400. Can we take $2,400 here? No. Why we should not take $2,400? Because the ICAI has taken assumption that when you take 20% of FOB, that 20% of FOB is from the factory gate of the exporter. Because ex factory price is given, means that 20% is for even 1,500 and 500 also. That 20% is for 1,500 and 500 also. So therefore, they are asking us to deduct less freight and loading charges. What is that less freight and loading charges? 2,000. So $2,000 should be reduced. So thereby we need to take only $400. Okay. So 20% of 12,000 is 2,400. In that already when you take 20%, these two are included. So we need to reduce. So $400 should be taken. Add insurance, and the insurance will be say ascertainable. We will take say insurance not ascertainable also. What we will do at the rate of 1.125% of FOB we will take. Here we don't have to do any adjustment. That is $12,000 into what is the rate? 1.125% means how much pa? So 12,000 into 1.125%, that is 135. So $135. So therefore assessable value will be taken as 135 plus 400 plus 12,000. So that will be $12,535 will be taken as the assessable value in this case. This is the way in which we need to do the answer if you get a question for CA final. For CMA final, only this is the place where there is a difference. That is, they don't have to deduct. Even reality also they don't have to deduct like this. Only ICAI special case. So they have to do like this, importer. But reality is that no one is doing like this. And that is the place where there is a difference. But for your exam, be careful. You have to follow this only, even though it is pathetic, stupid, idiotic. But we have to do this way only because I have given like this. and therefore 400, 135, 12,535. What if freight is actuals given? If freight actuals is given in the question, then what we will do? If freight actuals is given in the question, then we will not do all these things. Directly we take the actuals only. Only when freight is not given in the question, we need to do it like this. Okay. What if it is air freight? Okay. Suppose what if freight is somewhere like 2,500, like that it is given in question. What if freight is 2,500 given? Then you will not do anything. You will take ex factory price, that is FOB price $12,000. FOB price you will take as $12,000 and you will take freight as how much? 2,500. You will not reduce because actual is given. Definitely you will take actuals. And only in case when you take 20%, we have this problem. Add insurance. So insurance will be 1.125%, no change, 135. Then the answer will be 12,000 plus 2,500, that is $14,635 will be taken as the assessable value. Okay. What if it is air freight? What if air freight? What if it is air freight? Suppose if it is air freight, what we will do in this case? So first we will be taking FOB price. FOB price will be no doubt $12,000 that we will take, and add air freight. How much is the air freight? Air freight will be actuals. How much is actuals? Actuals will be from the beginning 1,500, 500, and so whatever actuals that is given, that should be taken. Okay. So what if air freight is given as $1,500? Then actuals you take. What is the actuals? 1,500 plus 500 plus 1,500. What is this? 2 times 1,500. First 1,500, because we are comparing 20%. When we take 20%, we need to compare it from the factory gate. So 1,500 plus 500 plus the actual air freight 1,500. So that will be equal to, actuals will be, so 3,500 be 20% of FOB. 20% of FOB will be 2,400. Whichever is lower. So whichever is lower, that is 2,400. But directly we will not take it. Again we need to reduce, minus already considered in FOB. Already considered in FOB we should take. What is that which is already considered in FOB? That is 2,000. How 2,000 we have already considered? That is this 1,500 and 500. So 2,000 already considered in FOB. That should be reduced, which means 2,400 minus 2,000. So $400 will be taken as the air freight, and again insurance. So insurance will be, insurance is like 135 that we will take, and the answer will be same. So 12,535. 12,535. Sometimes the actuals may be less. Then we need to take whichever is lower. From that also we need to deduct this 2,000, no doubt. Because in actuals also you are taking this 2,000. For example, in this case, what if the actuals is somewhere like $200 extra? 1,500 plus 500 plus 200. Then it will be 2,200. 2,200 or 2,400. Whichever is lower will be 2,200 minus already considered FOB will be 2,000. So the remaining $200 only will be taken in the outer column. You understood? That is with respect to this. And none of this discussion is applicable for CMA final. So wherein they have to do it normally. Whatever we have in the regular way, that only should be taken. So this is the special point. Based on that only I have discussed the illustrations. First, customs valuation. When ex factory price is given, freight from exporting country to India is available. If it is air freight, then we need to make this adjustment. That is actuals. Actuals you take from where to where? From a factory of exporter, from factory to importer's airport, or 20% of FOB, whichever is lower, minus freight from factory to load airport, and loading charges you should take out. Correct? That's what we did, pa. We are taking actuals, 20% of FOB minus already considering FOB we reduced. So remaining will be taken as the freight, that is this. Suppose if it is available, freight is available, but other freight, actuals. That's what here. What if freight is 2500 actuals given? We are taking that only. And what if freight from exporting country to India is not available? So when freight is not at all available, we need to follow the same way. What is that? Freight at 20% of revised FOB minus freight from factory to load airport and loading charges. Say this. So FOB price we are getting, freight we are taking 20%, from that we are reducing freight and loading charges from there to load airport or port. So we will get the freight, that is this. This is the special adjustment to be done. So keep it in mind. Then next one, customs valuation in case of import. So the following sequence to be applied. First we need to take transaction value. All these customs valuation rules is given 2007. Rule 3 talks about transaction value. So for what we discuss this transaction value only, and we need to make the adjustments as per rule 10. 10.1 and 10.2 we need to make adjustments, and customs officer shall not have any doubt as to truth and accuracy of the declared value. They can reject the value. So generally the value which is declared by the importer need not be blindly accepted by the customs officer. Based on the comparable imports, they can reject the value considering the truth and accuracy of declared value. And 4 conditions should be satisfied for transaction value. First, it should be unrestricted sale, means the exporter is selling to India, selling in India, like exporter is exporting to India and there is no restrictions on the importer. And unconditional sale, exporter is not keeping any conditions on the importer, and it is unrelated person, means importer and exporter are not related, and price must be the sole consideration. These 2 conditions we have even in GST also. Price must be the sole consideration, supplier and recipient should not be related, and that is this rule 3, transaction value. When transaction value fails, number 1, customs officer reject the value. Number 2, price is not the sole consideration. Number 3, if they are related. Number 4, if the exporter is putting conditions on the importer to make the sale, or if the exporter is restricting the importer for the sale. So in all these cases, transaction value fails and we need to determine the value subsequently. Rule 4, identical goods. Transaction value of identical goods should be taken. Identical goods means those goods which are imported and sold in India at or about the same time. Identical, same to same goods. Imported goods, so you are importing, that should also be imported goods. Same physical characteristic, quality and reputation, same to same. Produced in the same country, you are importing from Japan, that should also be from Japan. And in which the goods being valued were produced by the same person, preferably, but it is not compulsory, and it should be by the same person. For example, you are importing Samsung, the comparable should be LG, comparable okay, not necessarily same person, but you are importing from Taiwan, that should also be from Taiwan, but the manufacturer need not be the same person. And then we need to make the adjustments with respect to difference in quantity. You are importing 2000 units, the comparable imports is 5000 units. What if they import 2000 units? That adjustment we need to make. And difference in transportation cost. You are importing into Chennai port, but the comparable imports are made in Surat port. Then Surat port to Chennai port, what is the extra freight that we need to add? That is adjustment in transportation cost. Difference in commercial level of importation. You are importing from manufacturer. That person is importing from a dealer. What if he import from manufacturer? The dealer margin will be eliminated. So that adjustment to be done. So these are the 3 adjustments. Difference in quantity, difference in freight, and difference in commercial level of importation. Then after making these adjustments, we need to arrive at the value. And if we have more than one value of identical goods, the lowest of such value is considered. Who will do the valuation here? Customs officer will do the valuation. But in GST, open market value, like and quality, everything should be done by the taxpayer. But here importer will not do. The customs officer will do the valuation. So they will have the data that is available. Then suppose if identical goods are not there at or about the same time. Identical goods means same to same, no change. But in case of identical goods not available, they can go for similar goods. Similar goods means commercially interchangeable. For example, you are importing a fridge. You are importing a fridge, refrigerator. So a single door refrigerator can be compared with a double door refrigerator. And you are importing a washing machine. A top load washing machine can be compared with front load washing machine. Like that, it is similar, interchangeable. but don't compare refrigerator with washing machine. That is not interchangeable, okay? So therefore, similar goods, transaction value of similar goods. So that is also imported goods, commercially interchangeable and produced in the same country, produced by the same person preferably. Only one change, that is here it should be same physical characteristics quality, here commercially interchangeable. And here we have to make 4 adjustments. What are the 4 adjustments? Number 1, difference in the quantity, difference in the transportation cost and difference in the commercial level. These 3 are same, but extra one more difference in adjustment we need to make. For example, you are importing a top load washing machine. For front load washing machine, usually the price will be extra. When you take a comparable washing machine as front load, the extra cost will be there that you eliminate. From top load to front load, what is the usual price difference? Say 15,000, that needs to be reduced. That is this. Difference in material, engineering work adjustment we need to make. Now when you do this, when you get more than one transaction value, the lowest of such value will be considered. Then rule 6, when the above rules are not applicable, that is you are unable to identify, that is customs officer is unable to identify identical goods or similar goods, then the next one, they can follow either deductive value or computed value. In deductive value, what will happen? The sale price in India after the importation will be taken. So they do the reverse working. They see the selling price in India after importation and all post-importation expenses will be taken out. What are the post-importation expenses? So that is selling commission in India, GST in India, customs duty paid in India and transportation cost from port to the place of importer. All post-importation expenses are reduced, so you will get the price prevailing at the time of importation. They take the selling price after importation and go backwards, so they derive the price at the time of importation. Selling price of the imported goods are identical goods or similar goods to unrelated buyers, less post-importation expenses including customs duty. Rule 8, computed value. Computed value, they will take cost of production plus profit and general expenses plus freight and insurance. That is, we start from there. We see what is the cost of manufacturer raw material, that is producer outside India, exporter outside India, raw material cost, labor cost, overhead cost, like that. We take everything including the profit of the exporter till our place of importation, everything we will add. So that will be called as computed method. Either deductive value method or computed value method can be chosen by the importer. So not necessary that the sequence needs to be followed. So it can be in any order. Suppose if computed value is low than the deductive value, they can go for computed value. If the deductive value is low, they can go for deductive value. So importer has the option to choose in this case. Then rule 9. Rule 9 talks about best judge value. So in case of best judge value, the officer will determine the value based on the principles of valuation, but there are certain conditions to be satisfied. Number 1, sale price in India should not be taken just like that. So no value shall be determined on the basis of sale price in India of the goods produced in India. That should not be taken because that is not scientific. Number 2, sale price of goods in the domestic market of the exporter country, that also should not be taken. Sale price of the goods for export to country other than India, the third country export price also should not be taken. Cost of production of identical goods or similar goods, that also should not be taken. See, all these cannot be determined. No value shall be determined on the basis of this. And then highest of two alternatives or minimum customs values or arbitrary or fictitious values should not be taken, which means that the customs officer, based on the principles of valuation for this particular import of goods, should ascertain scientifically as to what is the value, and that may be accepted by the importer or he may contest that value, and on that he can go for appeal. So this is called as self-assessment. Whenever you file a bill of entry, the value rejected by the customs officer, they will do the reassessment, and when they do the reassessment, it is up to you whether to accept that reassessment or you can go for appeal against this. That is this. Then next, valuation in case of export. In case of export, always we need to take which value? FOB price should be taken. So assessable value, price prevailing at the time and place of exportation, that is FOB price, and we don't have to do any adjustment in this regard. And what are the rules we have? So first, rule 3, assessable value equals to transaction value. Proper officer should satisfy that the declared value is genuine. Even in case of related party, transaction value may be acceptable. And rule 4, that is transaction value of goods of like kind and quality. They are identical goods in case of import, but here like kind and quality is a word given. So what is that? For example, you are exporting some goods and the value is rejected by the officer. Usually officer reject the value because you will be declaring a higher value for export benefits. So they will reject the value. Then they will take goods of like kind and quality. Means that comparable goods also should be exported goods and same physical features and characteristics, and that is produced in the same country. That is, produced in the same country in which goods being valued were produced and produced by the same person. So those goods also should be manufactured in India, and those goods should also be manufactured by the same person, but preferably not compulsory. Now you are taking that 3 adjustments, like import also, here export same 3 adjustments. What are the adjustments? So difference in the quantity, difference in the transportation cost, difference in commercial level. Suppose if multiple values are ascertainable, the lowest value will be taken. Directly then computed value method. In computed value method, they take cost of production plus profit and general expenses will be taken. And next step, best jet, and we don't have freight cost because we are taking FOB, we are exporting, we take only up to port of our export. So therefore freight and insurance will not be added. If you see here, cost of production plus profit and general expenses plus freight and insurance referred above is there in case of import, but in case of export we don't have that. We take only cost of production, profit and general expenses. And rule 6, best judged value. It has been specified that local or Indian sale price of the same goods may be taken as the best judged value if seems reasonable. So best judged value determined by the officer. And we have related in the context of customs. So we have seen family scope. The same definition is applicable even for customs also, but there are 2 changes. Number 1, in case of GST, family is defined, spouse and children of the person, and whether or not dependent, brothers, sisters, parents and grandparents of the person, if they are wholly mainly dependent like that, it is defined. But in customs, same definition, no change. So what is the difference? Family is not defined. Okay. So family scope, the meaning of related under GST, the meaning of related under customs, both are same. The meaning of related under GST, family is defined, but here family is not defined. So therefore any person can be covered under family here. And next, in case of GST, 2 companies having a common shareholder holding 25% or more makes them related. But here 2 companies with a common shareholder having 5%, just 5% make them related. Meaning of related in the context of customs is same as the meaning of related in GST, except that in customs, person holding 5% or more equity in 2 persons make them related instead of 25% or more in GST. Then declaration by the importer or exporter. Importer or exporter or his agent shall furnish the declaration disclosing full and accurate details relating to the value of imported and exported goods. And rejection of declared value, I told you, proper officer to reject value of imported goods or exported goods declared by importer or exporter when they will declare, when they have reason to doubt the truth or accuracy of such value, then it shall be deemed that transaction value of such imported goods or exported goods cannot be determined under rule 3, which means we will not take CIF price and FOB price. So this is with respect to valuation. Then look into baggage provisions. See the baggage provisions, page number 269. Baggage refers to passenger's luggage. Any person who is bringing the goods through his luggage, either accompanied or unaccompanied, that will be covered under baggage, and baggage is subject to duty, and we have 2 different rates of baggage duty. The normal rate of baggage duty is 38.5%, that is 35% basic customs duty, 10% social fare surcharge. So 38.5% is the baggage duty. Whereas in case of 3 goods imported, that is number 1, so pistols, firearms, cartridges of firearms exceeding 50, then cigarettes exceeding 100, cigars exceeding 25, tobacco exceeding 125 grams. In that case, it will be 110%, 100% plus 10% on that. That will be the rates of baggage duty. So what are the 3 goods for which 110% will be applicable? You can see, that is firearms, cartridges of firearms beyond 50, cartridges of firearms beyond 50. See there in the last page I gave a table related to the rates. So generally 38.5%, but only for 3 places it will be 110%, firearms 110%, cartridges of firearms beyond 50 110%, cigarettes beyond 100 sticks 110%, cigars beyond 25 numbers 110%, tobacco beyond 125 grams 110%, in all other cases it will be 38.5%, and we need to pay that as the baggage duty. However, we have certain allowances. First allowance is general fee allowance. Before that, we have two exemptions. Exemption number 1, used personal effect is exempted. So then number 2, one laptop brought by a person over the age of 18 years. Laptop brought by a person over the age of 18 years. These two are exempted. Sir, is it 18 years and above or greater than 18 years? Greater than or equal to 18 years. Okay. Even if exactly they are 18 years also, that laptop exemption is there. So passenger of 18 years and above coming from anywhere, one laptop computer or notebook computer will be exempted. Whether tab is covered under the exemption? No. Tab is not covered under the exemption. Personal computer, no one will bring. If they bring also, that is not covered under the exemption. I mean desktop or desktop, no one will bring na as a baggage. So laptop is only allowed, laptop or notebook computer. Then personal effects. Which personal effects? Used or unused personal effects? Used personal effects. And used personal effects, whether smartphone will come under used personal effects? Yes. Mobile will come under used personal effects. So therefore it is exempted. But be careful in question when they give mobile, which means that is a new mobile. It is not used personal effects. If it is used personal effect, they would have grouped it under used personal effect. Only when in the question it is given as used personal effect, it is used personal effect. If it is given separately, then it is a new one. Means it will be dutiable. Only two exemptions. Number 1, used personal effects. Number 2, laptop more than 18 years or equal to 18 years of age. Apart from these two, all others will be dutiable. But whenever it is dutiable, we have certain allowances. So rule 3 and 4, general fee allowance. General fee allowance is available to a passenger of Indian origin and foreigners residing in India excluding infants. And general fee allowance, you see, so easily you can remember, for other than Nepal, Bhutan and Myanmar, for other than Nepal, Bhutan and Myanmar, other countries, if they are coming from, if they are tourists of foreign origin, it is up to 15,000, balancing figure up to 50,000. Okay, tourist of foreign origin, then it is up to 15,000, all others will be up to 50,000. If they are coming from Nepal, Bhutan, Myanmar, if they are coming by land route, it will be nil. If it is other way, then it is 15,000 rupees. Then for infant, there is no general fee allowance. If they are coming from any country, there is no general fee allowance, only used personal effects they can bring. So who is infant? Child not more than 2 years of age. There is one super point that is given, that is used personal effect of infant is exempted provided the infant is traveling. Because in one question, past exam question, they have given that a person is bringing the clothes of the infant for free distribution in India, but the infant is not traveling with him. So infant's clothes he is bringing, that infant's clothes is not his clothes, so that is considered as dutiable. You understood? That is considered as dutiable in that question. Only infant is traveling, then the infant's personal effects will be exempted. But the infant is not traveling, but the infant clothes is brought in India for free distribution, but that will be treated as dutiable, because personal effects means the traveler's personal effects. The traveler's personal effects, keep that in mind. Okay, so see this general fee allowance in addition to used personal effects of whom? Of the traveler, and travel souvenirs. Travel souvenirs are brought to India in order to distribute, like as a memory of that particular country. So to visit they will be bringing. So as these are, like travel souvenirs, usually it will not be in commercial quantity, just 1 or 2 they will be bringing. So this is anyhow allowed. Travel souvenirs and used personal effects is allowed. Apart from that, so Nepal, Bhutan, Myanmar, land route there is no general fee allowance. Other cases up to 15,000. And if tourist of foreign origin, in case of other countries, tourist of foreign origin up to 15,000, other cases up to 50,000. This is the general fee allowance. And used personal effects and travel souvenirs, irrespective of value, is freely allowed. Personal effects do not include jewelry. If jewelry is brought, definitely that will be dutiable unless the jewelry allowance is available. So if jewelry allowance is available, then okay, otherwise dutiable. Personal effects means things required for satisfying daily necessities but does not include jewelry, and the free allowance of one passenger cannot be pooled with the free allowance of other passenger. For example, two people, husband and wife, they are bringing one PlayStation for their son when they are returning. So this PlayStation cost is 75,000 rupees, and therefore 75,000 rupees, even though cumulatively these two people 50,000, but only one allowance is available, remaining 25,000 will be dutiable. So the free allowance of one passenger shall not be pooled with the free allowance of other passenger. Also, the free allowance is not applicable to Annexure 1 items. What are those Annexure 1 items? These are the Annexure 1 items. Total 6 Annexure 1 items are there. In that, the first 3 are the ones for which 110% is applicable. What are they? Firearms, cartridges of firearms exceeding 50, cigarettes exceeding 100, cigars exceeding 25, tobacco exceeding 125 grams. Then apart from that, what you need to remember is LED, LCD, plasma TV, alcoholic liquor in excess of 2 liters, gold or silver in any form other than ornaments. Other than ornaments. Suppose if you are bringing jewelry, can you claim general free allowance? Yes, because other than ornaments they are telling. So for jewelry we can claim general free allowance. Gold or silver, biscuits or gold bars, etc. we cannot claim general free allowance. These are the 6 goods for which general free allowance is not available, which means should we pay duty? Yes, we need to pay duty. And also general free allowance for household items are not available under this rule, because for that household items we have a separate rule. However, it can be claimed under rule 6. Then next rule what we have is jewelry allowance. Jewelry allowance is given under rule 5. Rule 3 and 4 is general free allowance. Rule 5 is jewelry allowance, and general free allowance is also available. Jewelry allowance also available. Here it's not that if one allowance is available, the other one is not available like that. So cumulatively they can claim everything. And jewelry allowance is Indian passenger who has been residing abroad for more than 1 year. Here actually this Indian passenger is not given in the study material. In the study material they did not mention which passenger, but in the traveler guide that is released by CBIC, it has been mentioned as Indian passenger. So sir, for our exam, should we consider this jewelry allowance only for Indian passenger or any passenger? Any passenger. For ICI exams. For ICI exam, any passenger. Because they did not give Indian passenger in the study material. Okay. So ultimately, whether it is a mistake also, study material is only the Bible for us. And therefore we need to follow that only, no other go. So any passenger who has been residing abroad for more than 1 year, male 20 grams with a value cap of 50,000, female 40 grams with a value cap of 1 lakh. For example, there is a male passenger who is bringing 25 grams and the 25 grams ka value is somewhere like 60,000 rupees. Okay. Now, how much will be the allowance? First, 60,000 divided by 25 grams into 20 grams you need to see, because weight wise you need to see what is the value. So 60,000 divided by 25 into 20, that will be 48,000, or value wise it will be 50,000, whichever is lower, that is 48,000 is the allowance. 48,000 is allowance. Therefore, what is the dutiable value? The dutiable value will be 12,000. Hope you understood how we did this. So 25 grams they have brought, value of 60,000. First we need to see weight wise only 20 grams. Therefore 60,000 divided by 25 into 20, 48,000, or value wise only 50,000, whichever is lower. So 48,000 is the allowance. So 60 minus 48, 12,000 will be taken as the dutiable value on which 38.5% is payable. That's how it should be taken. For female passenger it is double, 40 grams with a value cap of 1 lakh. Will the value be given in the question? Of course, value will be given in the question. Then, what are the entitlements to a passenger? And very, very important, they should be staying abroad for more than 1 year. Exactly 1 year, no allowance. Greater than 1 year. The stay abroad should be greater than 1 year. Greater than 1 year. Then only the allowance is available, jewelry allowance. And what are the entitlements to a passenger who is transferring residence to India? Depending upon the time period stayed abroad, the passenger, but here definitely Indian passenger only will be getting, so that is clearly given. And fulfillment of conditions, all the household articles they will be able to bring, and what is the limit up to which they can bring. If their stay is 3 months to 6 months. 0 to 3 months, nothing, no allowance, only general fee allowance. 3 months to 6 months, up to 60,000 they can bring. And 6 months to 1 year, up to 1 lakh they can bring. And minimum 1 year in the preceding 2 years, up to 2 lakhs they can bring. Beyond 2 years or more they can bring. So 5 lakhs worth of goods. So 3 to 6 months, 6 for 60,000. 6 months to 1 year, 1 for 1 lakh. Minimum 1 year in the preceding 2 years, 2 for 2 lakhs. And then minimum stay of 2 years or more, it will be 5 lakhs. And in the third point, you see, should not have availed this concession in the preceding 3 years. And fourth point, shortfall up to 2 months, that is 2 years or more, but exactly 1 year, 10 months, it's okay. The 2 months can be condoned by ACDC. Also, stay in India during the short visit should not be more than 6 months, which may be condoned by commissioner, and this concession should not be claimed in the preceding 3 years. Conditions and all you please remember, then only this allowance will be available. What are the ineligible articles for this rule 6? All annexure 1 articles ineligible, plus some more articles are also listed in annexure 2. Color TV, whichever is really essential which they bring, that is disallowed. Color TV, video home theater system, dishwasher, refrigerator above 300 liters. Up to 300 liters means single door. If it is double door, definitely it exceeds 300 liters. A person who is going to outside India, why he will compromise with single door refrigerator? So therefore, that's what I told. Whichever is essential, they have kept it under disallowability. So color TV not allowed, video home theater not allowed, dishwasher not allowed, refrigerator above 300 liters not allowed, deep freezer, video camera, cinematograph film of 35 mm and above. Then what is available? Plate, cup, saucer, gas stove, all those are available. Yes, all those are eligible. Those are the household articles, that is eligible. Then other points, all the above provisions are equally applicable to unaccompanied baggage also. What is unaccompanied baggage? The baggage which arrives after 1 month from his arrival or before 2 months from his arrival. So A for after, B for before. Alphabet A is 1, B is 2. So 1 month after arrival, 2 months before arrival. That is called as unaccompanied baggage. Then even for members of crew also, baggage provisions are applicable only at the time of completion of their contract. During the time when they are in contract, they can bring only petty gifts up to 1,500 rupees. After their service, normal concession will be available. Person carrying non-dutiable goods and non-prohibited goods, they should walk through green channel. If they are bringing any dutiable or prohibited goods, they need to walk through red channel. Passenger has to make true and full declaration regarding the contents of the baggage. And there is something called as temporary detention of baggage. Temporary detention of baggage means whenever the baggage of a passenger contains some dutiable, like prohibited articles or dutiable articles, and he need to make a true declaration, and he can detain those articles there itself. He don't have to pay any duty. When he is returning from India, so he can take those goods, or he can authorize any other person to take those goods, or he can ask the customs officer also to send those goods. But very important condition is that they should have made a true and full declaration. If they are bringing some gold biscuits and suddenly if they are caught, at that time they cannot say temporary detention, sir, when I am going I will take. No, only if they have made true declaration it is possible. That is this, where the baggage of a passenger contains any article which is dutiable or import of which is prohibited, and in respect of which a true declaration has been made, the proper officer may at the request of the passenger detain such goods for the purpose of being returned to him on his leaving India. For any reason the passenger is not able to collect. Okay, either the article may be returned to him or through any other passenger or as a cargo consigned in his name. Dutiable goods brought into India taken abroad on returning baggage provision shall be applicable if true and full declaration is not made while going abroad. That is, whenever you are leaving outside India and all those goods needs to be declared and taken outside India. If those goods only you are bringing, then you are not required to pay baggage duty. For example, you are wearing full jewelry and you are leaving from the country and you did not do any declaration, and thereafter you are returning. At that time you are subject to baggage duty on the jewelry which you are bringing. Sir, the same jewelry manufactured in India is taken. All these things we don't know. So why you did not do declaration? So while returning, pay the baggage duty. That is this point. Then customs duty rates on baggage. See, whenever you get a question, you need to prepare the answer like this. First, eligible for GFA, not eligible for GFA. Eligible for GFA, always rate will be 38.5%. Not eligible for GFA, we have two rates, 38.5% and 110%. First we need to see firearms, where it will come. Not eligible for GFA, 110%. Cartridges of firearms up to 50. For example, 75 cartridges you are bringing. then up to 50 will be coming under eligible for GFA 38.5. Remaining 25 you will keep it under not eligible for GFA 110%. Then cigarettes you are bringing, cigarettes say 150 cigarettes you are bringing, so 100 cigarettes you will keep it under eligible for GFA 38.5. Remaining 50 cigarettes will be under not eligible for GFA 110%. Then same way cigars, same way tobacco, up to 25, up to 125 grams eligible for GFA 38.5. Beyond that limit only it will be under 110%. Gold or silver other than ornaments, where it will come not eligible for GFA, but the rate is 38.5% only. What if it is ornaments eligible for GFA and the rate will be 38.5%? Alcoholic liter, so you are bringing 5 liters, 2 liters will be kept under eligible for GFA, remaining 3 liters not eligible for GFA, but the rate is 38.5% only. Then LED, LCD, plasma TV will be not eligible for GFA 38.5%, and all other goods will be eligible for GFA. Like that, if you segregate in a table, then it will be easy for you. Finally, you can put, that is amounts you need to enter, then you need to put minus general free allowance, minus jewelry allowance, whichever allowance is available, you put it under minus. So finally you get the dutiable value. On the dutiable value, you take accordingly. If it is first column 38.5%, and if it is next column also 38.5%, last column it will be 110%. Okay, then so jewelry within limit also we need to give true declaration, sir. Anything, because you are going outside India and you are returning after 1 year, no problem. But you are returning immediately, anything, even 20 grams jewelry also you need to give true declaration. But practically the officers may not verify 5 grams, 10 grams, 20 grams, 40 grams also. Basic jewelry they are not checking. But just because they are not checking does not mean the provision is like this. Okay. So the law we are learning for exam purpose. So that is with respect to this, we completed baggage. And look into the next area, that is warehousing under customs. Warehousing under customs. Say this. So any goods which are imported can be kept in a warehouse with payment of duty or without payment of duty, without payment of duty. So it can be deposited in a warehouse, and that warehouse is licensed by the customs department. What are the different types of warehouse? Public warehouse, private warehouse and special warehouse. Public warehouse, goods belonging to any person can be imported, not only the license holder, goods belonging to any person. But in a private warehouse, only goods belonging to the license holder can only be deposited. Public warehouse, goods belonging to any person can be deposited, but in private warehouse, only goods belonging to licensee can be deposited. And only notified goods so can be deposited in special warehouse. What are the list of that notified goods is not for exam, but just remember there are some notified goods which can be deposited in special warehouse. And the difference of special warehouse over public and private warehouse is that in the special warehouse there will be customs lock and key, so which will be under the customs lock. And if warehouse license is cancelled on account of breach of condition, every warehouse keeper should fulfill certain conditions of the license. If he breached those conditions, then his license will be cancelled, and goods deposited in such warehouse should be transferred to either another warehouse or cleared for home consumption within 7 days from the date on which cancellation order is served. And warehousing bond is required to be executed, and for which, when the goods are deposited, you are not going to pay the customs duty. As you are not going to pay the customs duty, you need to execute a bond, and that bond will be two types, either consignment bond or general bond. Consignment bond means every time when you are depositing, you will execute the bond. General bond means one flat amount which is specified by the customs officer, we will be executing. So consignment bond will be 3 times the customs duty payable at the time of deposit. So at the time of deposit, whatever is a customs duty payable, say 1,50,000 into 3, 4,50,000 we will execute a bond. Executing a bond means not that we are paying the duty, just a stamp paper we will be executing, that is this. And what is the amount for general bond? As specified by the proper officer. So warehousing bond plus prescribed security. Importer has to furnish warehousing bond plus security for warehousing of goods and or for transferring the goods from one warehouse to another warehouse without paying the customs duty. And consignment bond already we discussed, thrice the amount of duty assessed. General bond Assistant Commissioner, Deputy Commissioner may permit importer to execute a general bond in respect of goods warehoused within the specified period. Upon execution of bond, what will happen? Officer shall pass the warehousing order, that is under section 60, and warehousing period. Once they pass the warehousing order, what is the period for which the goods can be deposited in warehouse? 1 year. Can it be extended for a further period of 1 year? Yes. But in case of perishable goods, that 1 year can be reduced also. Considering the nature of goods, it may be reduced or enhanced. This period is not applicable for EOU, EHTP, STP, and warehouse where manufacturing operations are permitted. In that case, indefinite period, the goods can be kept in the warehouse. So to where warehousing period is not applicable, EOU, EHTP, STP, and warehouse where the manufacturing operations are permitted. So 1 year should be counted from the warehousing order. Then interest is applicable. From the warehousing order, first 90 days, there is no interest. But after 90 days, we need to pay interest at the rate of 15% per annum for every day until the actual date of payment of customs duty with respect to that warehoused goods. So 15% from 91st day after the date of warehousing order till the date of actual clearance and payment of customs duty. Then manufacturing and other operations are permitted in the warehouse and duty not payable on such warehoused goods if the processed goods are exported. So whenever we are importing the goods, those goods can be processed and then exported or cleared for home consumption. So we can do the manufacturing process in our warehouse itself. However, customs duty payable on the waste and scrap generated. For example, we are importing the cloth, and for that cloth we have to pay the customs duty at the rate of 12%. But what we did not clear it for home consumption. We kept it in the warehouse. That cloth got deposited in the warehouse. From that cloth, we made the garments, and that garments got exported. So we imported 2000 meters of cloth and 1900 meters of garment we have exported, and the cut pieces of cloth, the waste and scrap, we have to the extent of 100 meters. But this 100 meters of waste and scrap is also out of the imported goods. So on this 100 meters, should we pay the customs duty? We have two options. Option number 1, destroy that 100 meters. So no need to pay any customs duty. Or you clear that 100 meters of waste and scrap in domestic tariff area, that is you clear it from warehouse. So for this you need to pay the customs duty, because this waste and scrap is also out of the imported goods only. At what rate we need to pay customs duty on this waste and scrap? At the rate applicable to the waste and scrap, not at the rate applicable to the imported goods. That is this. So manufacturing and other operations are permitted in warehouse and duty not payable on such warehoused goods if processed goods are exported. However, customs duty payable on the waste and scrap at the applicable rate to waste and scrap arising out of manufacture if such waste and scrap is not destroyed within the warehouse, which means we need to either destroy the waste and scrap or clear the waste and scrap from the warehouse upon payment of customs duty. What customs duty we need to pay on that waste and scrap? At the rate applicable to that waste and scrap. Say the rate applicable to waste and scrap is 5%, that 5% should be taken, and we should not take 12%, the value, the rate applicable to the original import, that is cloth. Then in case of volatile goods, customs duty payable or not payable? Not payable. That's what I told you, that whiskey which is imported, which is kept in the warehouse, got evaporated, we don't have to pay customs duty with respect to that evaporated quantity. And treatment of waste in the manufacturing or other operation in relation to warehoused goods, if whole or part of the goods resulting from such operations are exported. What is it I told you? Import duty to be remitted. Waste and scrap is to be either destroyed or duty to be paid at the rate applicable to waste and scrap. Whereas if they are cleared for home consumption, no relaxation. On the imported quantity, you need to pay customs duty, because those imported goods, even though processed and cleared for home consumption, including the waste and scrap, you need to pay the customs duty on the imported goods. Import duty to be charged at the applicable rate to the goods imported. Then see this overview, that is, as soon as the goods are imported, those goods imported will be kept under the custody of the custodian for a period of 30 days. So in the port or airport, and in that 30 days period, the importer can file a bill of entry for warehousing or inbound bill of entry, and it will be cleared without payment of customs duty, but a bond needs to be executed. And here thereafter, for which warehouse it can be taken? After filing inbound bill of entry, a warehousing order will be passed, and it can be taken to a public warehouse, private warehouse, or a special warehouse. Public, private, and special, all three warehouses are licensed by the principal commissioner or commissioner and public warehouse, private warehouse, record based control, special warehouse there will be physical control, and public warehouse store goods belonging to any person, private warehouse store goods belonging to license holder, special warehouse store notified goods belonging to any person. And thereafter manufacturing and other operations are permitted in warehouse. What is the period for which it can be kept in warehouse? For EOU, EHTP, STP are private warehouse. What is private warehouse means? Warehouse where manufacturing operations are permitted, no time limit, and interest free period, there is no interest also. Whereas for others, 1 year from warehousing order and the interest free period is 90 days. Thereafter, the goods should be either taken to another warehouse, and another warehouse, when one warehouse to another warehouse, when the goods are taken, whether they need to pay any customs duty, no, just a transfer request they need to make. No bill of entry, but a transfer request to be made. Customs duty not payable and the bond will be retained, and we will count the overall period of 1 year. So it's not like every warehouse 1 year, 1 year, 1 year like that. All the warehouses put together, that 1 year is a warehousing period. Then, or the goods can be cleared for home consumption, that is to importer's place, for which an ex-bond bill of entry should be filed for home consumption by the importer, and it is cleared upon payment of customs duty, and should they execute whatever bond that is executed, that gets released. Bond executed shall be released. In this regard, there is one important case law, that is Kesoram Rayan case or SBEC Sugars case. In both these cases, the Supreme Court held that if the goods are not cleared within the permissible warehousing period, on expiry of that warehousing period, the goods are deemed to have been cleared. That date, whatever rate of duty is there, that is only you take. Generally, we take the rate of duty prevailing on ex-bond bill of entry. But in case of this case, Kesoram Rayan case or SBEC Sugars case, when the goods are not cleared within the permissible warehousing period, on expiry of that warehousing period, whatever is the rate, that should only be taken, but the interest will be computed till the time actually you are going to pay the customs duty. Goods deemed to be improperly cleared on expiry of warehousing period, and in case the goods are taken from the warehouse for export, so imported goods deposited in warehouse and from there it is exported. So we don't have to pay any customs duty with respect to that goods. Customs duty not payable, and whatever bond, that bond will be retained. No bill of entry, but the shipping bill to be filed. So here, whenever the goods are taken outside India, bill of entry is not required, but the shipping bill is to be filed, and the customs duty is not payable in this case. And why the bond will be retained? Because whenever you are exporting, so till the time it is actually exported, until that point of time, so there is no proof that you are really exporting it or not. So thereafter the bond will be released after the export. So whenever the customs officer cross verifies with the export manifest or export report, etc., then the bond will be released. Okay, in future it will be released, immediately it will not be released. Okay, that is with respect to this. And next, what are the owner's right with respect to the warehoused goods? Either they can inspect the goods or sort the goods or show them for sale, but caution to be exercised to prevent loss or damage or deterioration, because if there is any loss or damage or deterioration in the warehoused goods, the customs duty will come down now. So if this is because of the negligence of the importer, the customs abatement will not be given. Abatement will be given only if it is not due to negligence of the importer. When goods are cleared after warehousing period, relevant date for determining rate of duty shall be taken on expiry of warehousing period and not when ex-bond bill of entry is filed. That is Kesoram Rayan case and SBEC Sugars case. So these are some points which we have seen. Now look into this. So I wanted to discuss few questions from your study material quickly. Yes, see this question. Compute the total customs duty payable and integrated tax under customs law on an imported mission based on the following information. Cost of mission at the factory of the exporter is $20,000. Transportation charges from factory of exporter to the port for shipment will be $800. Handling charges paid for loading of the mission in the ship will be $50. So therefore 20,000 plus 800 plus 50 will be taken as the FOB price because this is the ex factory price. Freight charges from exporting country to India is $5,000 that is given. Buying commission paid by the importer is 100. Light rate charges paid by the importer. Light rate charges is part of the freight, yes. Light rate charges and bar charges is part and parcel of the freight. Freight incurred from port of entry to inland container depot is 60,000. See, transit charges will be part of, right, but transshipment charges will not be part of, right, that you need to keep in mind. And next thing, whenever we are importing the goods to a port or airport, from there when we take it to inland container depot or container freight station, this is post importation, so that will not be included. Ship demurrage charges, yes, that will be part of, right. And date of bill of entry, date of entry inward, integrated tax. Whether here the freight from outside India to India is given. So freight from exporting country to India is clearly given. So actuals are ascertainable. So what should we do in that case? First we need to take ex factory price. The ex factory price will be 20,000. That you take 20,000 we need to take, and then transportation charges from factory of the exporter to port 800 and handling charges 50. So therefore 20,850 will be taken as FOB. So the FOB will be $20,850 will be taken. Then freight you don't add now. Wait, buying commission paid by importer, it will not be included. Only selling commission paid by importer will be included. Light rate, freight and ship demurrage, all these are part and parcel of freight. So therefore this is the FOB. And add freight. What is the freight that we need to take? The freight will be $5,000 plus $5,000 will take actual ascertainable plus light rate is also part of freight. But here this 20,850 need to be converted into Indian rupees. What should be taken as a relevant exchange rate? Date of bill of entry or grant of entry inwards, whichever is later should be taken for rate of duty. So for rate of duty we will be taking 25th March or 20th January, whichever is later, 25th March for rate of duty. For exchange rate always it will be bill of entry date, that is 70 rupees per dollar. So 20,850 into 70 rupees so that will be coming to 14,59,500. Then this $5,000 into 70 you take. So 5,000 into 70, that is 33,50,000. Correct? Next we have light rate charges in Indian rupees. Be careful with respect to foreign currency in Indian rupees. So light rate charges 12,000. So we need to take the 12,000 light rate charges. And freight incurred from port of entry to inland container depot. This is a post import. So we will not take. Ship demurrage charges, yes, part and parcel of freight. So 24,000. Any other expenditure? No, we don't have. This will be taken as the assessable value. So 14,59,500 plus 3,50,000 plus 12,000 plus 24,000. So that will come to 18,45,500. But we don't have the information about insurance. Insurance is not given in the question. As insurance is not given in the question, we need to take 1.125% of FOB. So see, nowhere it is given. Only freight is given. Insurance is not given. So even if it is not given, we need to take insurance. What is that insurance? So 14,59,500 into 1.125%, that will be, so 16,419.375. So that plus 18,45,500, that will come to 18,61,919.375. So that will be taken as the value. Okay, but see this question number 9. So 18 lakh 61,919.38. Okay, and that should be rounded off. That should be rounded off, but they have not did the rounded off. They have not done in the study material. So all values should be rounded off to nearest to 1 rupee. So it should be rounded off. So keep that in mind and don't round off the intermediate calculation. Suppose in between you have anything, please don't round off. Because of that also they will deduct the marks. Because of that also they will deduct the marks. So don't round off in the middle. Only the final number you round off, and thereafter you need to take the basic customs duty. So that is 18,61,192 and social welfare surcharge, IGST will be computed. So that is normal. You understood the valuation in this case, even though the ex-factory price is given, but they have ascertained the freight actually. So here you don't have to do anything with respect to this. Then another question, you see this question number 16. Product Z was imported by Mr. X by air. The details of the import transaction are as follows. Price of Z at exporter's factory 8,500. Freight from factory of exporter to the load airport. Airport in the country of exporter. Loading and handling charges. So this two is part and parcel of the FOB price. So therefore the FOB price will be $9,000. Up to this the FOB price will be taken as $9,000. Okay. Then freight from load airport to the airport of importation in India and insurance charges. Here what we need to do is that we need to compare air freight. What is the actuals? So we are taking air freight pa. Air freight, what is the actuals? Actuals is how much? Actuals is 4,500 plus 250 plus 250, because you are going to compare with 20% of FOB. So what is the actuals? Actuals will be 5,000 and B 20% of FOB. What is the 20% of FOB? 9,000. 9,000 into 20%, that is 1,800. Whichever is lower, that is 1,800. From that you need to take out 500. 500. Why you need to take out 500? Because already it is in FOB. So therefore 1,800 minus 500, only 1,300 will be taken as the freight. So then insurance actual ascertainable, that is 2,000. So see what is the assessable value. We don't have anything else. We don't have anything else. All these are rates only. So what is the assessable value? 9,000 plus 1,300. 9,000 plus 1,300. 9,000 plus 1,300 plus 2,000. So that will come to 12,300. 12,300 will be taken as the total assessable value multiplied with what is the exchange rate. So though the aircraft arrived on 22nd August, bill of entry for home consumption was presented on 20th August. So bill of entry is presented on 20th August. As on that date, CBIC rate is 70. So into 70, 8,61,000. You got it? So I'll show you the answer. You will believe in me. So say this. So question number 16. 8,61,000. Happy? So what I said is correct. And therefore, how they did, we don't have to bother about it. How they did, we don't have to bother. They also did the same way, but they messed it. So first 8,500 they have taken, then inner column they have taken 250, 250 and 4,500. So actually is 5,000. For them also 5,000. And cost of transport restricted to 20% of FOB, 1,800. So this 250, 250 they kept it in the inner column. But how 1,800 they will get? How 1,800? 8,500 into 20% is not 1,800. So that you will completely break your head in order to know how 1,800 came. So 1,800 is 8,500 plus 250 plus 250. What I did is that these two I kept it in the outer column and I reduced it from 1,800 to arrive. So what they did is directly they have taken, but what we did or they did the same. We also got 12,300. On that we need to multiply with 70. So 8,61,000 will be taken as the assessable value. So this is one question. Next, look into this question number 19. This question number 19 is related to rule 8, computed value. Mr. X imported certain goods from related person. Mr. Q of US on transaction value has been rejected. 4 and 5 are not found applicable. Therefore, X furnishes the cost data for determining the value as per rule 8, that is computed value method. So as per computed value method, what should we take? We need to start from the cost of material. So material cost you take, fabrication cost you take, other chargeable expenses, yes, other indirect cost, yes, freight from Q's factory to US port, yes, loading charges, yes, all these are cost. Normal net profit margin is 20% of FOB. As it is 20% of FOB, so only when you add profit you will get FOB. So therefore 20% on sale price. FOB is like profit on sales. What is the profit on cost? So if sales is 100, profit is 20, then 20 by 100. Cost will be 80. So 20 by 80. 20 by 80 is 25%. So therefore 20% of FOB will be taken as 25% of cost. Correct? So what is the cost data up to this? Up to this the cost data, if you see 2000 plus 1000 plus 400 plus 250 plus 250 plus 100. So that will come to $4,000. $4,000 and the profit will be 25% of cost. So therefore we will add the profit. What is the profit? 1000. So therefore we will get the FOB, that is $5,000. Then air freight is given. Air freight from US port to Indian port. Okay. Now whatever air freight is given, what we should do whenever air freight is there, we need to take actual or 20% of FOB, whichever is lower. What will be taken as the air freight? Please respond. How much will be taken as the air freight? What is the actual air freight? Actuals. What is the actuals? Don't take 1500 alone, because we need to take from the factory gate. From the factory gate. So 1500 plus freight from Q's factory to port 250 plus 100, that will be equals to, so 1500 plus 250 plus 100, that will be 1850 is the actuals. And B, 20% of FOB. What is the 20% of FOB? 5000 into 20%, that will be 1000. Whichever is lower, that is 1000. From this 1000 minus what is already considered in FOB, 250 and 100, 350. So 1000 minus 350, that is 650, should be taken as the air freight. So therefore freight will be taken as 650. Then insurance. What is the insurance? Ascertainable 50. So therefore the answer 5700. And what is the exchange rate? 70 rupees per dollar. So 5700 into 70, that will be 3,99,000 rupees will be taken as the assessable value. The customs authorities are of the opinion that since a value as per rule 7, that is deductive value, can be determined at 4 lakh, there is no need to apply rule 8. No. So the importer can decide between either deductive value or computed value. In this case, as computed value is only 3,99,000, they can go for this computed value. Now also we did the same. Minus already considered in FOB we reduced. So if it is for one answer, if it is by coincidence, then this answer also should be correct only, na? 3,99,000, you see the answer. So 3,99,000. Okay, clear? So follow this path. This is the place where we make a mistake, because of which we will be losing the marks. That is, whatever I taught you, that strictly you need to follow. Okay. Then next one, you see, this is computed. So these questions, all these questions are similar. We did majorly, we did deductive value also. One question they asked in the past, simple. The deductive value is very simple. Reverse working only. All post importation expenses we need to reduce. And next, I can discuss it from solved workbook. It is there. But only when we discuss it from study material, you will be happy. No, okay, fine. Whatever we are learning is correct only, like that you will have a confidence. See this question. This is one warehousing question, very important question. This model, quite a long time they have not asked, they can test it. Say this. Vipul imported, they asked last attempt. IBS they asked. Okay. IBS they asked, it seems. Fine. But indirect tax they have not asked, na? We will learn. So people imported certain goods in May. An into-bound bill of entry was presented on 14th May and goods were cleared from the port for warehousing, and assessable value on that day was $1 lakh. The order permitting the deposit of goods in warehouse for 4 months was issued on 21st May. Vipul deposited the goods in the warehouse on the same day but did not clear the imported goods even after the warehousing period got over on 21st September. So what is the date on which warehousing period got over? 21st September. How? The order for deposit was on 21st May. So 21st May plus 4 months will be 21st September. Warehousing period got over but they did not clear, which means that this is deemed to be the date of clearance. As the goods are not cleared within the permissible warehousing period, as per Rayan case, on 21st September, the goods are deemed to be improperly cleared. A notice was issued under section 72 demanding duty and interest. What Vipul did, he actually cleared the goods on 14th October. Compute the amount of duty and interest payable by Vipul while removing the goods on the basis of the following information. Now, what should be taken as the relevant exchange rate? In case of warehoused goods, the relevant exchange rate is the date of inbound bill of entry. What is the date on which inbound bill of entry is presented? 14th May. Therefore, the relevant exchange rate is 65.20. That is on the date of inbound bill of entry, exchange rate should be taken. For rate of duty, which should be taken? Usually ex-bond bill of entry should be taken, but 14th October they will file ex-bond bill of entry, that we will not take. Because of Rayan case, we will take on 21st September, so the rate will be 10% basic customs duty. IGST leviable, but it is exempted, and ignore agriculture infrastructure development cess. Now, what should be taken as the assessable value? The assessable value will be $1 lakh, $1 lakh, $1 lakh, $1 lakh into what is the exchange rate that should be taken here? That will be 65.20. So that is 6 lakh, 65 lakh 20,000 is the assessable value, and then we need to take basic customs duty. What is the basic customs duty? 65 lakh 20,000 into 10%, that is 6 lakh 52,000, and social welfare surcharge 6 lakh 52,000 into 10%, that is 65,200. So what is the customs duty payable? So that is 7 lakh 17,200. Okay. So 7 lakh 17,200 is the customs duty payable, and now we need to compute the interest. So what is the interest period? Interest at the rate of 15%. Be careful, in oversight what we do in the flow, 18% will take. Okay, be careful, customs will be 15%. Interest at the rate of 15% on 7 lakh 17,200 from which date? So from 91st date, from the warehousing order till the date of clearance. So now what is the period you need to take? What is the period you need to take? What is the warehousing order? 14th May, correct? 14th May is the warehousing order. When are you actually clearing? To 14th of October. 14th of October is the date on which you are actually clearing. You take the period. So 14th May, that is 31 minus 14, that is 17 days in May, June 30 days, July 31 days, August 31 days, September 30 days, October 14 days, that will be 153 days. From this 153 days, you take out 90 days. Why you need to take out 90 days? Because interest free period will be 90 days. Rather than first counting 90, thereafter you counting the remaining days, overall we will take and minus 90 we will do. So therefore 153 minus 90, that will be 63 days. For that 63 days, we need to compute the interest. So the interest will be 7 lakh 17,200 into interest 15% into 63 divided by 365. So that will be 18,569. 568.60. 569 will be taken as the answer. So see this answer. So total customs duty payable 7,17,200, and the interest will be, so here 19th August 16,505. 56 days. How we are 56 days? August is 90 days expires. How come? 21st May a warehousing order. Correct. 21st May is the warehousing order. Correct. I did the mistake. 31 minus 21, that is 10 days in May, June, July, August, September, October. So it will be correct. 146 days. 146 days minus 90 days, that is 56 days. For 56 days automatically it will change. That is 7,17,200 into 0.15 into 56 divided by 365, 16,505, correct. Okay, so we need to count it from the warehousing order. So I thought 14th as the warehousing order, 21st May is the warehousing order. So this is one type of question. Okay, on computation this type of question may be tested, and this question, you see, this is related to the combustible nature. BL Limited imported superior kerosene oil and stored in the warehouse. This is the Biocolari case. Biocolari case, a Supreme Court decision. I have given some important case laws at the end, and somehow this Biocolari case can be tested. I'll tell you what is this case about. They imported the goods, they kept in the warehouse, and after they kept in the warehouse, they have paid the customs duty. They cleared the goods from the warehouse. I mean that they filed the ex-bond bill of entry and they paid the customs duty, but they did not actually clear the goods because of the combustible nature of the superior kerosene oil. They just kept it in the warehouse, and at a later point of time they wanted to clear, but they paid the customs duty. They filed the ex-bond bill of entry, they paid customs duty, etc. Everything got over, and at a later point of time when they wanted to clear, say after some 20 days, 30 days, meanwhile the rate on these goods got increased. So therefore customs department is asking them to pay the extra duty. Are they required to pay extra duty? No, because ex-bond bill of entry has already been filed and the customs duty has been paid, and just because the goods are kept in the warehousing period, it does not mean that the goods are covered under the customs warehouse. So therefore it may be kept in the warehouse, so customs duty already paid, so whenever there is an increase in the rate of duty, we don't have to pay. That is that Biocolari case. Okay, say this Biocolari Supreme Court decision. So this can be tested. Okay, and this is about today's discussion. So what we have completed in customs, majorly we completed taxable event, we completed classification and types of customs duty, valuation, baggage, and then warehousing. Okay, so can we do one question on baggage? One question we'll do. Baggage is not a separate chapter, but they have given it under procedures. We will say this. Gregory Pegg of foreign origin has come on travel visa to tour in India. Definitely tourist of foreign origin. So tourist of foreign origin means what will be the general fuel allowance? The general fuel allowance will be up to 15,000 will be taken as the general fuel allowance. And he carries with him as a part of the baggage the following: travel souvenir 85,000, travel souvenir is exempted, we don't have to pay. Other articles carried on in person, so that will be dutiable, 126 of cigarettes of 100 rupees each, 12,000, and firearm with 100 cartridges, value includes the value of cartridges at 500 rupees per cartridge, and determine the customs duty payable if the effective rate of customs duty is 38.5% inclusive of social welfare surcharge. So what we need to do in this case, first 120 cigarettes, so we need to separate. 100 cigarettes will be covered under general fuel allowance. So therefore 1,50,000 we are taking, so 10,000 rupees. So 1,50,000 plus 10,000, and next, because the remaining 2,000 rupees will be beyond 100, firearm with 100 cartridges, up to 50 cartridges will be coming. So first 100 into 500, how much? 50,000, but the value is 1 lakh. Then the remaining 50,000 is what? Firearm value. But in that 100 cartridges at 500, 50 is allowed. So 50 into 500, that will be 25,000. So total 1,50,000 plus 25 plus 10, 1,85,000. 1,85,000 minus 1,85,000 minus 15,000, that will be 1,60,000. Okay, into 38.5%, 1,60,000, sorry, 1,70,000 into 38.5%, that will be 65,450. You do this, then you write one more line. First you complete 38.5%, then you write one more line, that is this 2,000. You have to put it in a table, okay? That 2,000 rupees of cigarettes, 2,000 rupees cigarettes and 25,000 cartridges beyond 50 and 50,000 rupees firearm. So this 77,000 will be dutiable at 110%. 110%. So that's how you need to present it in the exam. Next, after visiting USA for a month, Mrs. and Mr. Iyer, Indian residents aged 35 and 40 years respectively, brought to India laptop computer valued at 70,000, used personal effects 1,40,000 and personal computer 58,000. 70,000 is exempted. Laptop more than 18 years or equal to 18 years, personal effect is exempted, but the personal computer 58,000 will be dutiable, but they cannot claim combined allowance. Only one allowance they will be able to claim. So therefore only 50,000, remaining 8,000 rupees will be dutiable. And on that baggage duty, 38.5% is payable. Mrs. X, an Indian resident, 36-year-old, who was on a visit to China, returned after 6 months. She was carrying with her the following items. So Indian resident, 36, and personal effects. So 75,000 exempted, laptop exempted, jewelry, whether she stayed abroad for more than 1 year, no. So therefore jewelry allowance is not available, and music system 50,000. So total, that is 1,25,000. Only one general free allowance. So general free allowance alone is available. What is a general free allowance? Nepal, Bhutan, Myanmar only different provision, but China is others. So others, therefore 50,000 general free allowance is available, means remaining 75,000. For jewelry, can we claim general free allowance? Why not? We can definitely claim. So on that 75,000 into 38.5%. So you can see the answer for this last question. 75,000, 38.5%. Okay. So general free allowance can be claimed. So the customs duty 38.5% on that. That is with respect to this. Fine. So tomorrow we will continue with the remaining portion. So we need to discuss procedures, assessment, then refunds, stores and foreign trade policy. So with that, the remaining portion will be over. Okay. For the first time in rocket revision batch, every chapter I discussed. Okay. And that we will continue tomorrow. And tomorrow definitely we will try to wind it up as soon as possible. We will start discussing the mighty 50 questions. That will extend it till day after tomorrow. I will complete it. Okay. Thank you. And the test series, I just gave a pass to the test series. So what I will do, after this batch gets over, just give me some time, 4-5 days. I'll compile all the papers and I will put it as one PDF with solutions. Test series, like quarter portion test, mock test with suggested answers. I will give it as one single PDF, and that particular test series you take it up for test as per your preparation, etc. and all. Okay, fine. But all those questions are apart from our solved workbook. It's not there in solved workbook, it's not there in mighty 50. All these are different questions. Okay. படிச்சு செத்துடுங்க.